Please like, share, and subscribe. Wishing you happiness and good luck every day.
What if I told you that your biggest edge in the stock market wasn't some fancy degree or a complex computer algorithm, but, well, just your everyday life? It sounds kind of crazy, but that's the core idea from one of the greatest investors of all time. And today, we're going to unpack exactly how it works. Let's get right into it.
So we are diving deep into Peter Lynch's absolute classic One Up on Wall Street. Now, this guy isn't just some author who wrote a book. He's a legend. As the manager of the Fidelity Magellan Fund, he put up numbers that were just out of this world. And he did it all with a philosophy that is shockingly simple and honestly, really empowering for the rest of us.
And this quote, "This is the whole thing right here." Lynch's big, game-changing idea is that you have a secret weapon that the Wall Street pros just don't. It's the knowledge you've picked up from your job, from your hobbies, from just living your life. This isn't about being smarter than them. It's about using the unique insights you already have. All right, so here's our game plan. We're going to walk through 5 key ideas. First, we'll talk about beating the so-called smart money. Then we'll dig into your untapped advantage. After that, we go hunting for what Lynch famously called the tenbagger. Then comes the most important part, doing your homework. And we'll wrap it all up with the simple math that can lead to a lifetime of winning. Okay, first up, beating the smart money. You know, it's so easy to feel like you're in a David versus Goliath situation, right? You against these huge, powerful firms. But what Lynch argues is that their massive size and all their rules can actually be their biggest weakness. I mean, listen to this. That's a pretty bold statement. He's basically saying that the whole idea of dumb money is a myth. The only time you're dumb is when you blindly follow what the experts are telling you to do. Your independence, your ability to think for yourself, that's your power. And this just lays it out perfectly. The Wall Street pro, they're often stuck in an office, chained to a spreadsheet, worrying about what happens this quarter. But you're out in the real world. You can see that new coffee shop that has a line out the door every single morning, way before those sales numbers ever hit an official report. You can afford to be patient and focus on just a handful of really great ideas. That's the edge. So, if the pros have these blind spots, where does your superpower come from? Well, it's actually not a secret at all. It comes from the world you see and interact with every single day. Lynch is practically shouting this from the rooftops. The world around you is just filled with clues. It could be that new software that makes your job 10 times easier, or a product your company suddenly can't order enough of. These aren't just random little stories. They are genuine potential investment leads. Just think about it. The next time you're at the mall, really look around. You can immediately see which stores are buzzing with people and which ones are, basically ghost towns. You can see which brands' shopping bags are suddenly in everyone's hands. And it's not just shopping. Think about your job. If you're a doctor, you know which new medical devices are actually game changers. If you work in construction, you know which material supplier is crushing the competition. That's on-the-ground intelligence that Wall Street would kill for. And that right there, that's the whole game. It's about getting a head start. By just paying attention, you can spot the next big thing while it's still small enough to deliver those incredible returns, long before it becomes a Wall Street favorite. But here's what's so great. Even a master like Lynch can make mistakes. He openly admits he totally missed Amazon early on because his focus was on physical stores, on malls. And that's such a powerful lesson, right? The core principle of invest in what you know never changes, but how and where you look for it absolutely has to evolve with the times. So you're out there doing all this detective work. What's the grand prize you're looking for? Well, Lynch gave it a name, and it's a famous one. We are stalking the tenbagger. So what is a tenbagger? It's the home run. It's the investment that goes up 10 times what you paid for it. And the amazing thing is, finding just one of these can have such a massive positive impact on your portfolio that it can make up for a whole bunch of other picks that didn't work out. It's the real engine of building wealth. I mean, just do the math for a second. It's staggering. A $10,000 investment turns into $100,000. Now, that might sound like winning the lottery, but Lynch's point is that it's not about luck. It's the result of finding an amazing company and then having the patience to just let it grow. And don't think these things are some kind of mythical creature. Look at this list of huge winners from back in the 90s. These are household names. Dell, Home Depot, Microsoft, The Gap.
Millions of people were using these products every day. The clues were right there, hiding in plain sight for anyone who was paying attention. Okay, this next part is maybe the more important piece of the entire puzzle. You've spotted a great product, a popular store, a potential tenbagger, but you cannot, and I repeat, cannot stop there. An idea is just an idea until you do the homework. And this is a trap so many people fall into. Liking a company's coffee is a fantastic reason to start your research. It is a terrible reason, on its own, to buy the stock. Lynch is crystal clear about this. You should never, ever invest a single dollar before you check out the actual business fundamentals. So he gives us this really simple checklist he calls the 2-minute drill. It's about building a story for the company. First, are its earnings growing? Second, is the company financially strong or is it drowning in debt? You can usually find this stuff right on their website in their annual report. Third, who's their competition and how do they stack up? And finally, how are they going to keep growing in the future? You need to understand their plan. If you remember only one thing from this, let it be this: follow the earnings. Lynch was convinced that over the long run, a company's stock price will always follow its earnings. All the day-to-day zigs and zags of the stock price, that's just noise. It's a distraction. Focus on the business. And that brings us to our final section, building a lifetime of winners. This really isn't about being right every single time. It's about having the right mindset, the right psychology, to let your big winners do their thing. I mean, this should be a huge relief, right? You don't have to be perfect. You don't need a 10 for 10 batting average. Why? Because the math of investing is on your side. Think about it. The absolute most you can lose on a stock is 100% of what you put in. But your potential gain? It's unlimited. A stock can be a 10-bagger, a 20-bagger. There's no ceiling. This chart just shows that logic in action. So on the left, you've got Portfolio A. It has a decent return, 30%, not bad. But now look at Portfolio B. The only difference is we added one 10-bagger to the mix, and bam, that one single stock completely changes the game, more than tripling the portfolio's return. That is the incredible power of finding just one great company. So we'll leave you with this question, which really turns Peter Lynch's entire philosophy back to you. The next time you're at work, or at a store, or a friend is telling you about some amazing new product they love, pay attention. The clues really are all around you. The only question is, are you willing to do the homework to find them? Have you ever gotten the feeling that some people are just born to be great investors? You know, like they have some kind of sixth sense for the market? Well, today we're going to tear that whole idea apart. We're diving into the origin story of a true legend, Peter Lynch, to see how one of the best fund managers of all time learned to beat Wall Street. And trust me, his story starts in a place you would never, ever expect. And boom, right out of the gate, Lynch himself tells us that's not how it works. He's crystal clear. No one is born a great investor. He didn't have a stock ticker hanging over his crib. And really, this one idea, it's the foundation for everything he believed. Investing is a skill you learn, something you develop. It's not something you inherit. And his own life? Well, it's the ultimate proof. So if he wasn't born with it, where did this journey begin? Well, it wasn't in some high finance family. It was in a world completely haunted by the stock market's biggest disaster. For the Lynch family, the market wasn't a place of opportunity. Man, it was a place of deep, deep fear. And you really got to understand the kind of environment he grew up in. His family, they came of age during the Great Depression. So for them, the crash of 1929 wasn't some boring history lesson. It was a painful family story. The advice he got over and over was simple: stay away. Never get involved. They saw the market as nothing more than a casino, a craps game where the house always wins and you're guaranteed to lose your shirt. And get this story just perfectly sums up how deep that fear ran. The one stock story from his childhood was about his grandfather. He bought some shares in a company called City Service, right? He thought, hey, great name, must be a safe water company. Well, when he found out it was actually an oil company, he totally panicked and sold it all immediately. The punchline? That stock went on to soar 50 times over. It's a funny story, for sure, but it shows you just how allergic to risk the whole family was. Okay, so if the stock market was a no-go zone at home, where in the world did he learn about it? Not in a classroom, that's for sure. It was on a golf course. See, his father passed away when he was just 10, and Lynch started working as a caddy to help his mom out. And that decision, well, it changed absolutely everything.
Now just picture this for a second. He's 11 years old, caddying at this super exclusive country club, and the guys he's carrying bags for, they're not just anybody. They're the presidents and CEOs of huge companies, Gillette, Polaroid, and this is the important one, Fidelity Investments. So while he's chasing down their golf balls, he's basically a fly on the wall, listening to these guys talk shop about stocks, deals, and strategy. This wasn't textbook theory, this was the real deal, straight from the source.
And this unconventional education just kept going right into college. Lynch didn't go the normal finance bro route. Nope. He dodged the advanced math classes and focused on things like history, psychology, and philosophy. He had this famous saying that investing is an art, not a science. He thought that trying to nail everything down with complex formulas was actually a huge mistake. And his big takeaway? All the math you really need to figure out if a company is a good investment, you learn it in the 4th grade.
This quote, this is just classic Lynch. It's so brilliant. It's how he explained what was wrong with Wall Street. He said studying logic was the best thing he ever did because it helped him see how illogical the so-called experts were. He saw all these analysts and professors sitting around endlessly debating theories, just like the old Greeks arguing about a horse's teeth without ever bothering to, just walk over and look in the horse's mouth. Lynch's whole approach was just that simple. Stop arguing and go check the facts about the actual company.
All right, so he's got this one-of-a-kind education from the golf course. His mind is sharp from studying logic. It was time to put some skin in the game. It's 1963. He's a sophomore in college, and he's finally saved up enough money from caddying to buy his very first stock. Now, this wasn't some random bet he overheard. This was classic Lynch, even back then. He actually did his homework. He read this article about how air freight was the next big thing, did his research, and it all pointed to this one company, Flying Tiger Airlines. He felt good about it, he put his money where his mouth was, and he waited.
And this is where the story gets really good. His research was solid, his logic was sound, but the reason he thought the stock was going to be a winner, it was completely and totally wrong.
The real reason that stock went to the moon had nothing to do with the boring commercial freight trends he was studying. Nope. It was the Vietnam War. The U.S. government hired Flying Tiger to transport troops and supplies across the Pacific, and the company made an absolute fortune. What a powerful early lesson, right? Sometimes the thing that makes a stock take off is something you could never see coming. So what was the result? It was absolutely mind-blowing. The stock he bought for around $7 a share shot up to over $32. In his own words, it was his first 5-bagger, a stock that goes up 5 times. That one single investment, it paid for his entire graduate school education. He actually called it his Flying Tiger Scholarship. But more than that, it proved to him that these huge, life-changing returns were actually possible. So, with this incredible win under his belt, Lynch goes off to the big leagues. First to the famous Wharton Business School, and then he lands a job at Fidelity. And this is where his real-world, street-smart approach was about to go head-to-head with the, let's say, academic theories of high finance. Yeah, so at Wharton, he's learning about stuff like the efficient market hypothesis, which basically says you can't beat the market because all the information is already priced in. But then he's at his internship at Fidelity, and he's seeing guys who made a 20-to-1 return on Kentucky Fried Chicken. The professors taught the random walk hypothesis, that the market is totally unpredictable. But he saw the same great fund managers at Fidelity winning, year after year. It was a clear choice for him. He was going to stick with the people actually doing it, not the ones just talking about it. But, you also learn a ton from your failures. And boy, did Lynch have a doozy. He invested in a company called Maine Sugar. On paper, it was a can't-miss idea. You get Maine's potato farmers to grow sugar beets in their off-season. Everybody makes more money. Perfect, right? Wrong. The plan totally forgot about one thing, the psychology of Maine farmers. These guys were super cautious. They didn't plant hundreds of acres. They started with these tiny little test patches. By the time they were finally convinced and ready to go all in, it was too late. The giant new refinery went bankrupt because it didn't have any sugar beets to process. The stock was a total wipeout. And the lesson he took away from this, it's just hilarious and so specific. It wasn't some complex financial theory. It was a practical piece of wisdom about understanding people. It was just another reminder that a great idea on paper means nothing if you don't get the human element right. Okay. So here we are. We've seen the successes, the epic failures, the lessons learned from the real world versus the classroom. Now we get to the main event. It's 1977, and Peter Lynch is handed the keys to the Fidelity Magellan Fund. It was time to put everything he'd learned into practice on the biggest stage in the world. And of course, in true Lynch fashion, the market just had to have a little fun with him. He used to joke about something he called the Lynch Law, which was basically, whenever something good happens to Peter Lynch, the market tanks. And look at this. The day he was born, the Dow declined. The day he started at Fidelity, it fell. The day he got promoted, another big drop. And sure enough, the day he takes over the Magellan Fund, the market immediately kicks off a 5-month losing streak. You can't make this stuff up.
So when he takes over Magellan, it has about 40 stocks. The big boss at Fidelity, Ned Johnson, tells him, hey, you should really concentrate the portfolio. Cut it down to your 25 best ideas. Lynch, he nods politely, and then he did the exact opposite. He ended up growing the funds to over 1,400 stocks. And this really gets to the heart of his method. He wasn't just diversifying to be safe. He was like a bargain hunting machine. If he liked one savings and loan stock, he wouldn't just buy that one, he'd buy 150 of them. He basically owned entire industries. His philosophy was beautifully simple. When I saw a bargain, I couldn't resist buying it. And the result? Well, under his watch, the Magellan Fund went from a small $20 million fund to a $9 billion giant. It became the best performing mutual fund on the planet.
People often compared Lynch to the old humorist Will Rogers, who famously said he never met a man he didn't like. The joke was that Lynch never met a stock he didn't like. So it just feels right to wrap up with this gem from Will Rogers. It's so folksy and simple, but it perfectly captures the common sense heart of Peter Lynch's whole philosophy. It just cuts through all the noise and gets right to the point.
So what's the big takeaway from all this? The skills that make a truly great investor, you're not going to find them in a textbook or some fancy algorithm. Lynch found his by being curious, by listening to people, by learning from his screw-ups, and by trusting his own research. His entire journey just proves that great investors are made, not born. And that kind of leaves us with one last question to think about. If he found his investing edge on a golf course, where are you going to find yours?
All right, let's get right into it. We all have this image of professional investors, right? These Wall Street titans who know everything, the giants we're all trying to compete against. But what if that whole idea, professional investing, is actually a contradiction in terms? Today, we're going to unpack a really powerful idea from the legendary investor Peter Lynch. The notion that the pros are playing a completely different game than you are, and it's a much, much harder one.
I mean, wow. That's a pretty bold statement, isn't it? Especially coming from Peter Lynch, one of the most successful fund managers of all time. He's basically saying that the very structure of professional investing creates this paradox. It's a world filled with absolutely brilliant people who, more often than not, are prevented from making brilliant decisions. And understanding this, well, this is the key to unlocking your own massive advantage as an individual investor.
So here's how we're going to break it all down. First, we'll dig into what the Wall Street oxymoron really means. Then we'll explore the professional's prison, all the hidden rules and pressures that hold them back. After that, we'll uncover the amateur's edge, which is your secret weapon. And finally, we'll talk about how you can actually use that freedom by going it alone.
Okay, let's kick things off with Section 1, the Wall Street oxymoron. So why would a guy like Lynch, a Wall Street legend himself, call his own profession a contradiction? Well, the answer starts when you look at who's really running the show on Wall Street.
Now, when you first see a number like that, 70% of the market controlled by big institutions, it sounds pretty intimidating, right? You feel like a little fish in a giant ocean. But here's Lynch's big, counterintuitive idea. This is actually a massive advantage for you. Why? Because those giant institutions, they're not nimble speedboats. They're giant oil tankers, weighed down by rules and pressures that stop them from acting on their best ideas.
Now look, of course not every professional is a prisoner in this system. You've got your absolute legends, the true free thinkers. Guys like John Templeton, who was investing all over the world when nobody else was. Michael Price, a master at finding companies packed with assets you could buy for pennies on the dollar. John Neff, who loved buying great stocks when they were completely out of favor. And of course, Warren Buffett, who if he likes a company enough, he'll just, buy the whole thing. These guys are the exceptions that prove the rule. Because the truth is, for every one of these legends, there are thousands of what Lynch calls run-of-the-mill, timid, and copycat fund managers. Now, these are smart people, don't get me wrong, but they're stuck. They're stuck inside a system that rewards playing it safe and punishes originality. And this system creates something we can call the professional's prison.
Which brings us right to our second section, the professional's prison. And this is really the heart of the matter. We need to understand the invisible handcuffs that are holding these professionals back. Because this isn't about a lack of intelligence, it's about the system itself being broken.
So the first set of bars on this prison cell,
is a phenomenon called street lag. This is just the fancy term for the huge delay between when a company becomes a runaway success in the real world and when Wall Street finally gets around to discovering it. The pros are all waiting for other pros to make the first move, for some analyst to finally put a stock on their recommended list.
The story of The Limited is the perfect example of street lag in action. Get this, the company goes public in 1969. It takes 6 years and 100 stores before even a single institution buys in. By 1981, they've got 400 booming stores, and still, only 6 analysts are covering it. The massive gains, the real wealth, had already been made. The herd of over 30 analysts only stampeded in after the stock had already gone to the moon.
And this wasn't just a fluke. Look at this list. A funeral home company called Service Corporation International had 0 analyst coverage for its first decade. Subaru's huge growth in the 70s? Barely a handful of analysts bothered to watch. Dunkin' Donuts? I mean, a 25-bagger, and almost nobody on Wall Street was paying attention. The pattern is just crystal clear. Wall Street follows. It doesn't lead. They show up late to the party every time.
So why? Why the lag? It boils down to one simple thing: career risk. This quote just says it all. If a fund manager buys a big, well-known stock like IBM and it goes down, the client says, oh, well, that's IBM's fault. But if they buy some small, unknown company and it goes down, the client points the finger right at the manager and says, what were you thinking? The incentive is to play it safe, even if playing it safe means you're going to be mediocre.
This fear of being wrong then leads to another huge problem: bureaucracy. Lynch has this great name for it. He calls it the inspected by 4 method. You know, like those little paper slips you find in a new shirt? To make sure no single person can be blamed if a stock pick goes wrong, everything has to be run through committees. And let's be honest, a great book was never written by a committee, and a great portfolio was never built by one either. It's a recipe for an uninspired, totally average result.
Lynch paints this perfect little picture in his book that shows exactly how this plays out. Let's meet our pretend portfolio manager. We'll call him Boondoggle, and his very demanding client, a guy named Sam Flint. Sam's in the office to review how his portfolio is doing.
So just look at the client's reaction here. Sam Flint is loving the gains in the names he knows, like Xerox and Sears. Terrific. Excellent. But then, his eyes land on some little company he's never heard of, Seven Oaks International. And even though it's just a tiny piece of the portfolio, the fact that it's down from $10 to $6 completely hijacks the meeting. Poor Boondoggle has to spend the entire time defending this one single unconventional pick.
So what's the result of that painful meeting? Well, Boondoggle swears to himself he's never ever buying an off-the-beaten-path company again. He sells Seven Oaks as fast as he can, not because the company's fundamentals have changed, but just to avoid having another awful conversation with Sam Flint. This is what's called burying the evidence. Professionals are literally forced to sell promising companies for career preservation reasons, not for investment reasons. It's crazy.
Okay, so we've seen the professional's prison. It's a world of groupthink, bureaucracy, and career anxiety. But this is exactly where your opportunity comes from. This is where we get to talk about the amateur's edge.
I mean, the contrast here is just night and day. While the professional is trapped by rules and has to get approval from a committee, you are totally free to invest in whatever you want. While they're terrified of looking bad in front of a client, you are only accountable to yourself. While they're drowning in paperwork and meetings, you can make a decision in a split second. And maybe most important of all, while they learn about companies from other Wall Street analysts, you can get your best ideas from your everyday life.
And this is just so important. Your own real-world experience is a goldmine of information. You're the one who notices that new store in the mall that always has a line out the door. You're the one using that new piece of software at work that your company suddenly can't live without. You see these trends in your own neighborhood months, sometimes years, before they ever show up on a Wall Street analyst's radar.
So, this is the whole point. You have these incredible built-in advantages. The final, crucial question is, how do you actually use them? So let's talk about how to wield this freedom.
Just think for a second about all the things you don't have to do. You don't have a client like Sam Flint breathing down your neck. You don't have to write a 20-page report to justify your decisions to a committee. There are 0 rules stopping you from buying a small, unknown company. You can own 1 stock, or 4 stocks, or 10 stocks, whatever you're comfortable with. You can even sell a stock at 11 and buy it back at 19 if the story gets better, something a professional would get laughed out of the room for doing.
And get a load of this number, 1,400.
A massive fund, like the one Peter Lynch ran, might be forced to own that many different stocks. When you own 1,400 stocks, even your absolute best ideas get diluted down to almost nothing. You, on the other hand, are free to put your money behind your 5 or 10 best ideas. You can be concentrated, you can be nimble, in a way a multi-billion-dollar fund just can't.
And maybe the biggest advantage of them all is patience. A professional fund manager has to stay invested. They're constantly getting new money flowing in that they have to put to work, even if there's nothing good to buy. But you have the ultimate superpower, the power to do absolutely nothing. You can let your cash sit on the sidelines and wait patiently until a truly great opportunity comes along.
So let's tie this all together. At the end of the day, the stock market isn't just about spreadsheets and PE ratios. It's about conviction. And the professional system is almost perfectly designed to destroy conviction through committees, second-guessing, and career risk. It victimizes the unconvinced. But for the patient amateur, the person who does their own homework and develops real conviction, well, the system is set up to offer you incredible rewards.
In the end, your greatest strength is that you are not a professional investor. You have flexibility, you have independence, and you have the freedom to think for yourself. These are advantages the so-called experts on Wall Street can only dream of having. So the only question left is, how are you going to use them?
So let's just get right into it. We hear it all the time, right? Invest for your future. But if we're being honest, watching the stock market go up and down, it can feel a lot like you're at a casino, just pulling a lever. So what's the deal? Where do we draw the line between smart, careful investing and just pure gambling? That's what we're going to break down.
You know, for the longest time, this was basically gospel in the financial world. The idea was pretty simple. If you were a serious, prudent investor, you lent your money out and you collected interest. Stocks? That was for speculators, for the gamblers. But gentlemen, well, they preferred the safety and the sheer predictability of bonds.
And you know what? There's an incredibly powerful argument for this super cautious way of thinking. And to really get why, we've got to go back a few hundred years to maybe one of the most famous real estate deals in all of history.
Yeah, that's right. Back in 1626, the local Lenape people sold the entire island of Manhattan to Dutch settlers. And the price? Well, it's become the punchline to a centuries-old joke about getting a really, really bad deal.
The estimated value of all those trinkets and beads was just $24. I mean, it's a ridiculously small number when you think about what that island would become, the financial capital of the entire world. But this is where the story gets really interesting.
So check this out. If that original $24 had just been invested to collect 8% compound interest, which is a pretty reasonable historical average, by today it would be worth nearly $30 trillion. To put that into perspective, the total value of all the real estate in Manhattan right now is just a tiny fraction of that. A single patient investment in debt would have been worth more than the island itself. It's just mind-blowing.
And that really proves the point, doesn't it? There is absolutely nothing wrong with the simple act of getting paid interest, especially when you let it compound over time. The big insight here is that time can be your single greatest ally. It is an unbelievably powerful way to build wealth, and it totally validates that cautious, bond-loving perspective.
But that's only one side of the coin. Because as powerful as compounding interest is, when you look at the last century or so, stocks, well, they tell a very, very different story.
Okay, so we've established that a long-term, patient approach can pay off big time. But what happens if you take that exact same patience and apply it to something else? Let's do a little thought experiment. Imagine a person invests $1,000 in 1927 and then basically falls asleep for 60 years. They're totally immune to all the chaos, the market crashes, the wars, the recessions that would scare any of us out of the market. What would they find when they woke up?
The results are, well, they're just staggering. Now, don't worry about reading all the fine print here. The only thing that matters is the insane difference between the types of investments. Sure, bonds did okay, they delivered some respectable returns, but one of these investments just left everything else completely in the dust.
I mean, just look at this chart. That $1,000 in common stocks grew to $272,000. That's 15 times more than corporate bonds. And here's the kicker. This happened despite everything that went on in those 60 years. We're talking the Great Depression, World War II, you name it. Through all that turmoil, stocks delivered a far, far greater reward.
And there's a really simple reason for this massive difference. When you own a stock, you're a partner in the business. You own a tiny piece of its growth, its profits, its future. But when you own a bond, you're just a lender. The absolute best you can hope for is to get your money back plus some interest. The key takeaway here is to see yourself as a business partner.
not someone holding a lottery ticket. Because let me tell you, you are never, ever going to get a 10-bagger from a bond.
Okay, so stocks have way higher returns. That much is crystal clear. But everybody knows the rule, right? Higher returns means higher risk. But is that the whole story? Let's dig into that a little bit.
This is the big one, isn't it? This is the question that keeps people from investing, the one that keeps them up at night, and the simple answer is, yeah, of course they're risky. A stock owes you absolutely nothing. There is no guarantee.
And we're not just talking about some fly-by-night startups here. Even the so-called blue-chip stocks, the ones that are supposed to be the safest of the safe, can go completely nowhere or even just vanish. We're talking about giants of industry, RCA, Bethlehem Steel, American Cotton Oil, companies that just stagnated or disappeared. There is no such thing as a can't-miss stock.
But here's the flip side of that paradox. That safe alternative, the bond, it's not exactly the risk-free harbor it's cracked up to be. They come with their own unique and kind of sneaky set of dangers.
So, for instance, a lot of corporate bonds are callable. What does that mean? It means if interest rates fall, the company can basically just say, hey, thanks for the loan, but here's your money back. They cancel your awesome high-interest bond and then just go issue new ones at the new lower rate. And this happens at the exact moment that bond was becoming most valuable to you. And it works the other way too. If rates rise, your old low-interest bond is suddenly worth way less. And on top of all that, you've got the silent killer, inflation, just eating away at your spending power year after year. The point is, risk is everywhere.
So if everything has risk, both stocks and bonds, then what in the world separates smart investing from just reckless gambling? Well, it turns out the dividing line might not be the thing you choose to buy, but the person doing the buying.
This right here is the absolute core idea of this whole explainer. Investing isn't about trying to find some magical, risk-free thing. It doesn't exist. It's about managing the risk you decide to take on. It's about skill, it's about dedication, it's about doing the homework so that you can tilt the odds in your favor.
You know, the best analogy I've ever heard for this is a game of stud poker. Think about it. It's a game of skill, you have incomplete information, and there's a lot of psychology involved. And in so many ways, it is a perfect model for how a successful investor should think and act.
So how does this poker analogy actually work in practice? I mean, a good poker player doesn't just sit there and hope for good cards, right? No, they play the hand they're dealt using every piece of information they can get. And those same principles apply directly to investing.
In poker, you get to see some of your opponent's cards, right? Well, in investing, that's like doing your research. You're looking at the company's balance sheet, its earnings, its debt. And as new information comes in, say a huge jump in sales, that's like another card getting turned over. If the story gets better, you increase your bet. And if the facts start to turn against you, you fold, you sell.
And this leads to a really crucial piece of the mindset. Look, even the best poker player on the planet sometimes loses a huge hand to some lucky draw, a hidden royal flush. Successful investors get this. They know they're going to have losses. They accept unexpected setbacks. One bad investment doesn't scare them out of the game for good. They learn what they can, and they just move on to the next hand.
And here's the best part. You don't even have to be perfect. You don't need to win every single hand. If just 6 out of 10 of your stocks do what you hope they'll do, that's all it takes to build an absolutely enviable record on Wall Street. It's about being right more often than you're wrong over the long haul.
So at the end of the day, maybe we've all been asking the wrong question. It's not about whether investing is a gamble. Of course it is. Everything is. The real question, the only one that matters, is have you done the work? Do you understand the business? Have you analyzed the situation? And do you truly know the odds? Because once you do, you're not a gambler anymore, you're an investor.
Welcome to The Explainer. You know, every investor at some point asks themselves a very specific question. Today, we're going to tackle that, but we're going to do it through the eyes of a real legend, Peter Lynch, using a simple framework.
All right, let's just jump right in. This is the question, right? It's the one everyone starts with. You're asking your buddies, you're Googling like crazy, you're glued to the financial channels, all just hoping to find that one magic stock, that one hot tip that's going to be your ticket. And yeah, it totally feels like the right place to start.
But here's the thing. According to Peter Lynch, you know, the guy who ran the Magellan Fund into the stratosphere, asking about a specific stock is completely jumping the gun. He says, look, before you even think about analyzing a company's balance sheet, you've got to analyze yourself.
Yeah,
He literally says there's no point in opening the financial section of the paper until you've taken a good long look in the mirror. So that's what we're doing today. We're going to walk through his famous 3-question mirror test to figure out if you're really ready for the wild ride that is the stock market.
So, here's the game plan. We'll kick things off with the big idea behind the test. Then we'll get into why he thinks you might need to buy a house first. Yeah, a house. After that, we'll talk about whether you can actually afford to lose the money you're investing. And finally, we'll dig into the mindset. Then we'll see where you stand at the end. So, let's get into it. Lynch's whole philosophy boils down to this. Whether you win or lose in the stock market has way more to do with your own personal situation, your foundation, than it does with any fancy forecast or hot stock tip you'll ever hear.
All right, on to question 1. And honestly, this one might throw you for a loop. Lynch says that before you even think about buying a single share of stock, you need to seriously consider buying a house. Why? Because, as he puts it, it's pretty much the one good investment that almost everyone somehow manages to pull off successfully.
And this is where it gets really fascinating. Just look at the difference in how we behave. Think about buying a house, right? You spend months, maybe even years, looking. You're checking out the schools, the neighborhood, the plumbing. You hire inspectors. But when it comes to stocks, sometimes it's a decision made in, 5 minutes? The difference in effort is just staggering. And the data backs it up. We hold on to houses for about 7 years on average, but a crazy 87% of stocks on the NSY are traded every single year.
And this is exactly Lynch's point. A house is basically an investment that's kind of rigged in your favor. I mean, think about it. The bank gives you this incredible leverage. You can control a $100,000 asset with just 20 grand down. You get to deduct your mortgage interest, your property taxes, and here's the big one. The bank is never going to call you in a panic at 2 a.m. demanding more money just because home values in your neighborhood took a temporary dip. Unlike with stocks on margin, that just doesn't happen.
And this quote just nails it, doesn't it? It's not that Lynch is saying real estate is always a better investment than stocks. Not at all. His point is that the way we approach it and the way the whole thing is structured just naturally leads to better results for most people. That same level of care and research we put into buying a house, well, that's exactly what we should be doing with stocks, but almost nobody does.
Okay, so you've got the house situation sorted. Now we move on to question number 2. And this one is all about the money itself, the cash you're thinking about investing. The big question is, can you actually afford to lose it? And Lynch does not mince words on this one. He's super clear. If you need that money for something specific in the next 2 or 3 years, like say your kid's college tuition, it has absolutely no business being in the stock market, period. Why? Because over the long haul, like 10 or 20 years, stocks are pretty predictable. But in the short term, it's a total coin flip. Even the biggest, safest, blue-chip companies can take a nosedive and stay down for years. You just can't risk money you need on a short-term bet like that.
So this is what he calls his golden rule, and it is so simple but so powerful. It cuts through all the complicated financial jargon. Just ask yourself this one question before you invest a dime. If this money disappeared tomorrow, would it change my daily life? Would it affect my ability to pay the mortgage, buy groceries, or even just sleep at night? If the answer is yes, even a little bit, that money does not belong in stocks. All right, that brings us to the third and final question. And according to Lynch, this is the most important one of them all. This has zero to do with your bank account and everything to do with what's going on between your ears, your psychology. Do you have what it takes, personally, to be a successful investor?
And listen, this isn't about being some kind of brainiac. In fact, Lynch has this great line where he says the best investors are probably smarter than the bottom 10%, but dumber than the top 3%. It's not about brains, it's all about temperament. It's about having the patience to sit on your hands, the humility to say I was wrong, and maybe most importantly, the ability to stay cool and just ignore the mass hysteria when everyone else is freaking out.
And history proves over and over again that our collective gut feeling is usually dead wrong. I mean, look at this. At the end of '72, just before the market took a huge dive, almost everybody was bullish. Then in '74 and '82, right before these massive bull markets kicked off, most people were super pessimistic. The lesson here is so clear. If you wait until a trend is so obvious that everyone feels good about it, you've probably already missed the boat.
And this is how those faulty gut feelings trap us in this totally destructive cycle. So the market crashes, right? And you're full of concern, you're too scared to buy when things are cheap. Then, after the market's already gone back up and prices are way higher, you finally feel safe enough to buy in. You feel complacent. But then what happens? The market has another dip, your stocks drop,
and you hit capitulation. You panic, you sell everything for a loss, and you vow never again. Congratulations! You've just perfected the art of buying high and selling low.
So why? Why are we so bad at this? Why do we panic so easily? Well, it really helps to understand the nature of what you're buying, and it all kind of boils down to a single number, 50%.
What Lynch points out is that an average stock in an average year will fluctuate by about 50%. So let's make that real. You buy a stock for $50. It is very likely that sometime in the next year, it'll hit $60 and also fall down to $40. If you don't have the stomach for that roller coaster, if you're the person who's going to see it hit 40 and sell everything in a panic, then it doesn't matter how much research you did. You've got to be able to tolerate that pain.
Okay, so we've been through all three of Lynch's big questions. It's time to bring it all home. Have you passed the test?
So this is it. Time to look in that mirror. And you have to be totally honest with yourself. Do you have that stable foundation, like a house? Are you only planning to invest money that you could genuinely afford to lose tomorrow? And do you, deep down, have the emotional guts for it, the patience, the humility, the tolerance for pain to ride out the storms? Because if your honest answer to any of those questions is no, well, Lynch leaves us with this great piece of advice. It's funny, for sure, but it makes a really serious point. Yeah, the stock market can be a fantastic way to build wealth, but it's not for everybody, and it's not for every time in your life. Knowing yourself, that isn't just the first step, it's everything.
Let's talk about the one question that sends a shiver down the spine of almost every investor. Is this a good market? It's the question that legendary investor Peter Lynch says he gets asked more than anything else. But here's the thing. According to him, it is completely, totally the wrong question to be asking. And today, we're going to find out why. We have to start with this classic humble quote from the man himself. And look, this isn't just some funny quip. It's a really profound statement on just how useless market timing is. I mean, if a guy who averaged a 29% annual return for over a decade admits he has no idea where the market is going, it kind of begs the question, right? Why do the rest of us think we can?
All right, so here's our game plan. First, we're going to break down why trying to predict the market is the impossible question. Then we'll get into the psychology behind our bad guesses with a concept Lynch calls fighting the last war. After that, we'll have a little fun with his famous cocktail party theory. From there, we'll get to the real solution, investing in companies, not markets. And finally, we'll wrap it all up with Lynch's core principles that you can actually use.
Okay, let's just rip the Band-Aid off. Why is trying to guess what the market's going to do next such a losing strategy? Well, the evidence against it it's pretty overwhelming.
This is something Peter Lynch saw all the time. For every single person who came up to him and asked about a specific business, like, is Goodyear Tire a good buy? 4 other people would ask him about the overall market. Are we going up? Are we going down? And that right there shows you where our focus is. And it's a huge and really expensive misdirection of our energy. And don't think for a second this is just a problem for us amateurs. Lynch is the first to admit that he, along with a whole army of famous forecasters and so-called experts, completely missed the massive 1,000-point crash back in 1987. The same thing happened with the brutal bear market of 73-74 and the nasty recession in the early 80s. The smartest people in the room, they just didn't see any of it coming. Get your head around this number, 60,000. That's roughly how many economists there are in the US. And Lynch's logic here is just perfect. He says, look, if these folks could successfully predict interest rates and recessions just twice in a row, every single one of them would be a multimillionaire, retired, and sipping drinks on a beach somewhere. But they're not. The fact that they're still showing up to work every day, well, that tells you everything you need to know about how reliable those forecasts are. So here's the bottom line. So many of us are just waiting for a signal, right? Some kind of bell to ring that tells us, okay, the recession's over, or hey, a new bull market just started. But that bell, it never rings. You only get that kind of clarity when you're looking in the rearview mirror. By the time it's totally obvious what happened, the big opportunity is long gone. So if we all know prediction is basically impossible, why are we so obsessed with trying? Well, a huge part of the answer has to do with this psychological trap that keeps us forever looking backward. Lynch has this great name for it, penultimate preparedness. And it's this very human thing we do to make up for being caught off guard by the last disaster. The day after a market crash, suddenly everyone becomes an expert on market crashes. We get perfectly prepared for the crisis that just happened. To really hammer this home, Lynch tells this great story from Mayan mythology. The myth goes that the universe was destroyed 4 times. After the first time, a massive flood, the survivors all moved up into the trees. They built dikes, they were perfectly prepared for another flood. But of course, the next destruction didn't come from water, it came from fire. So the survivors of the fire moved away from the woods. They built their houses out of stone, only to be wiped out by an earthquake. And just like those Mayans, we investors are constantly preparing for the last disaster. We worried about inflation and we got a recession. Then coming out of the recession, we braced for more recession and got hit with inflation. We are always fighting the last war. Now, even though Lynch says he never predicts the market, he does have this hilarious but actually surprisingly sharp social barometer he calls the cocktail party theory. It's all about gauging the market's mood just by listening to the conversations around you. He breaks it down into 4 stages. Okay, stage 1, ignorance. The market's been down, nobody cares. When Lynch says he runs a stock fund, people just kind of nod and walk away to find a dentist to talk about plaque. Seriously. Then you get to stage 2, skepticism. The market's up a little, now people will listen for a second, but only to tell you how risky stocks are, before, you guessed it, going back to the dentist. Stage 3 is when it gets interesting. Interest. The market's up, say, 30%, and now a crowd surrounds him all night, begging for stock tips. Even the dentist is asking what to buy. And finally, stage 4, euphoria. And this is the top. The crowd is still there, but now they're telling him what to buy. The dentist is giving out hot stock tips on some new tech company. For Lynch, that's the giant flashing red light that the party is just about over. So if we can't predict markets, and trying to read the room is basically a trap, what on earth are we supposed to do? Well, the answer is the absolute core of Lynch's entire philosophy. It's all about a powerful shift in your focus. To really drive this point home, he brings in this powerful idea from another legend, Warren Buffett. Now, the idea isn't that the market literally doesn't exist. Of course it does. The point is that its day-to-day, week-to-week mood swings should mean nothing to a real investor. The only thing it's good for is to serve as a reference point, a place to see if someone else's fear or greed is making them offer you a great company at a stupidly low price, or maybe buy your shares at a stupidly high one. And here's the real kicker. Let's just say you're a genius. You nail it. You correctly predict the next big economic boom. Fantastic. But guess what? That prediction is almost worthless on its own because you still have to pick the right companies. I mean, just look at these examples from the book. You could have been 100% certain that computers were the future in the 80s. But if you picked a company called Fortune Systems, your $22 stock went to under $2. You lost almost everything. Same story with the steel industry's comeback. You could have called that perfectly. But if you bet on LTV Steel, you were wiped out. All while another steel company, Nucor, was just going to the moon. Picking the right industry just isn't enough. So the whole point here is to shift your focus. It's about going from the big, fuzzy macro picture down to the micro. Stop losing sleep over what the Dow Jones is doing. Instead, put that energy into figuring out if the companies you own are actually doing well. Is Taco Bell selling a ton of its new burritos? That's the stuff that actually matters. So how do we actually put all of this into practice? Let's boil it all down into a few core principles. Think of it as your new playbook to replace that old, broken game of trying to predict the market. Here are the big ones to remember. First, and this is the most important one, invest in companies, not in the stock market. Second and third, just accept that predicting the economy and the short-term market is a waste of time, so stop trying. Fourth, you have to learn to ignore the daily noise. Fifth, don't just assume the professionals on TV know any more about the future than you do. And finally, and this is so important, take advantage of what you already know. Your job, your hobbies, that's your superpower. That's your real edge. So let's end by going all the way back to that first question and flipping it completely on its head. All that time and anxiety we spend worrying about which way the market is headed is just a distraction. What if you took all that energy and just redirected it? What if instead of asking, is the market going up, you started asking a much more powerful and, frankly, a much more profitable question? Is this a great company? You know, making that one simple shift, that could change absolutely everything for you as an investor. Thanks for tuning in.
All right, let's get into it. Today, we are going on a hunt for the most sought-after prize in the whole investing world, the Tenbagger. It's a term for an investment that could literally change your life, and we're going to explore a surprisingly simple way to find one.
I mean, that's the big question, isn't it? How do you find that one stock that goes up 10 times? It's the kind of thing we all dream about, that one big win that could set you up. But how in the world do you actually find one?
Okay, so first things first, what are we even talking about? The term tenbagger was coined by the legendary investor Peter Lynch. It's pretty simple. It's an investment that goes up 10 times what you paid for it, a 1,000% return. Sounds like finding a unicorn, right? Well, as we're about to see, they might be a lot closer than you think.
Now, when you hear 1,000% return, you're probably thinking you need some super secret Wall Street info, right? Maybe a PhD in finance, a crystal ball. But the whole idea we're exploring today says that's completely wrong. The secret isn't locked away in some skyscraper.
Nope. The secret, the real secret, it's right under your nose. It starts in your backyard, at the mall you go to, or even at your 9 to 5. This is the big idea for today. Your own personal experience is your single greatest advantage when it comes to investing.
All right, so if these things are all around us, where do we even start looking? Well, this first section is all about opening your eyes and learning how to spot these opportunities that are basically hiding in plain sight.
The source material is just packed with these really simple, relatable examples. Think about a company like Pet Boys. Who knew it was a hit first? The employees, the suppliers, the thousands of customers who went there every week? They knew long before Wall Street caught on. Or, picture this, an usher at the local movie theater. They're seeing lines out the door every single night for weeks for some new blockbuster. A teacher might notice a new gadget that's saving them hours of grading. These aren't hidden clues. They're giant, flashing signals for anyone who's paying attention.
Okay, to really hammer this point home, to see just how powerful this edge can be, let's dive into a perfect case study. And no, it's not some hot tech stock. It's about a little pill that changed everything. So picture this. It's the 1970s. Ulcers are a huge, painful problem for tons of people. And then, this company, SmithKline, comes out with a drug called Tagamet. And it wasn't just a little better, it was a complete game changer, a revolution in a bottle. So who had the inside scoop here? Who knew this thing was a monster hit? It wasn't the fancy analysts in their corner offices. Nope, it was everyone on the ground floor. The doctors who were seeing their patients get better like overnight, the patients themselves, obviously, the pharmacists who couldn't keep the stuff on the shelves. Even the delivery guys probably noticed they were hauling truckloads of it. This was real-world, first-hand knowledge that this thing was a blockbuster.
And this chart, this just says it all. The author's own handwritten note here is so important. It says you could have bought the stock 2 years after the FDA approved Tagamet and still made at least a 3-bagger. Wow. You didn't need to be first, you didn't have to be an insider, you just had to pay attention to what was happening in the world around you, even years later.
So what did that look like? Well, the stock went from about $7.50 a share in '77 all the way up to $72 a share. That is almost a 10-bagger, all from a product millions of ordinary people saw and used every single day.
Okay, so if these huge opportunities are just staring us in the face, why do we miss them all the time? Well, that brings us to this really interesting psychological trap. Let's call it the grass is greener fallacy.
And this is just, it's so perfect. It captures the irony completely. The source speculates that the very doctors who knew everything about Tagamet, they were probably at some party getting stock tips about oil companies. And at the same time, you had oil executives who knew their own business cold, probably messing around with some biotech stock they read about in a magazine. It's crazy, right? We always think the best opportunities are in some other field we know nothing about.
And look, don't for a second think this is just something amateurs do. This is a quote from Peter Lynch himself, the guy who wrote the book. He's talking about the massive boom in his own industry, mutual funds. He was right there, at the center of the storm, and he admits it. How much did I make from all this? Zippo. Nothing.
This right here is such a powerful lesson, and it comes straight from his own notes. This is his chart for Dreyfus, a competitor. Look at his own handwriting. Here's one I never should have missed. Dreyfus, right in my own backyard. He saw it all happening. He says it right there. Money funds and bond funds take off. I saw it happening all around me. It was his day job, and he still missed it.
And the cost of that oversight? Oof. Dreyfus wasn't a 10-bagger. It was a 100-bagger. It went from 40 cents to nearly $40 a share. That is the incredible, almost painful price of falling for that grass is greener trap.
Okay, so we've established that having an edge is crucial, but it turns out there are different kinds of edges.
The source actually breaks it down into two main types, and knowing which one you have is totally key. So on one hand, you've got the consumer's edge. This is you, as a customer, noticing a new store that's always packed, or a product that all your friends are suddenly using. This is the pet boy's advantage. It's awesome for finding those new, fast-growing companies. But then, on the other hand, you have the professional's edge. This is your advantage from your job. You understand the deep cycles of an industry. You can feel when things are about to get better for old, established, maybe even kind of boring companies. You're the tire dealer who, after years of slow business, suddenly sees orders flooding in.
So how does that professional's edge actually work in practice? Well, the book lays out a super clear roadmap. Let's say you work in the chemical industry. First, you start noticing that demand is picking up. Your customers are just ordering more stuff. Second, you see prices are starting to get stronger. You're not having to give discounts anymore. Third, you look around and the warehouses are starting to look a little empty. All that extra inventory is finally gone. And fourth, and this is a big one, you know from being in the business that nobody's building a new factory overnight, so no new competitors are coming. You put those four things together, and that is a giant, blinking neon sign that profits are about to go through the roof for your whole industry.
And here's the kicker. This kind of grassroots knowledge, this on-the-ground intel, it doesn't show up in a quarterly report for months. So by paying attention at your job, you can be a full 6 to 12 months ahead of the so-called experts on Wall Street. That is a massive, massive head start. Which brings us right to the big takeaway, the one simple, powerful idea that ties all of this together. It's all about taking what you already know and actually putting it to work. I really want to leave you with this quote from the source because I think it just says it all so beautifully. So often we struggle to pick a winning stock, when all the while a winning stock has been struggling to pick us. We spend all this time looking for answers in complicated reports, thinking the secret is out there somewhere. But so often, the biggest opportunities are right in front of our faces, just waving their arms, trying to get us to notice. So that's the question I want you to walk away with. What's the tagamet in your world? What's the Dreyfus in your career? What hot new product? What big industry shift? What success story is happening right under your nose, right now, just waiting for you to see it? What winning stock is trying to pick you?
Have you ever felt totally overwhelmed trying to make sense of the stock market? Well, it turns out you might not need some complex PhD-level formula. What you might need is a simple but really powerful framework. Today, we're going to dive into how legendary investor Peter Lynch classifies any stock into one of just 6 categories. It's a first step that can completely change how you see your investments.
Okay, let's just start right here, because this quote, it gets to the absolute heart of the matter. Lynch's entire philosophy is built on this one simple idea. You've got to do your homework. It's not about being some kind of Wall Street genius. It's about simply looking at the cards you're holding before you decide to bet the farm.
So what happens when we don't do that homework? Well, Lynch has a pretty funny name for it, the Charman syndrome. And believe me, it's a common and very costly habit that most of us are guilty of without even realizing it. And this is the syndrome in action right here. We'll spend hours, maybe even days, researching the softest toilet paper, the cheapest vacation deal, the most efficient light bulb. But when it comes to investing thousands of dollars of our hard-earned savings, we often do it on a whim. It's this bizarre disconnect in our thinking, and according to Lynch, it is the single biggest reason investors make costly mistakes. This is one of the biggest traps out there. You see a popular new product, the media's buzzing about it, and you think, this is it. This is my chance. I've got to buy the stock. But is that really the whole story? Let's take a look at a classic example. And here is that trap in all its glory. So the market got wildly excited about a Johnson & Johnson cream that might fight wrinkles. The hype alone added over $1 billion to the company's value. But any investor who did just 5 minutes of real homework would have realized something crucial. The product's actual sales, they were a tiny, tiny drop in the bucket for a giant company like J&J. The hype was totally disconnected from the financial reality. And this brings us to Lynch's core solution. He argues that the antidote to all these mistakes isn't some fancy algorithm or a degree in finance. It's about becoming a storyteller. It's about taking that hot tip you heard and then doing the work to develop the full story of the company behind it. So here's our game plan for breaking down Lynch's solution. First, we're going to dive into his 6 core categories, starting with 3 very different types of growers. Then we'll tackle the tricky cyclicals, look for hidden value in turnarounds and asset plays, and then wrap it all up with the most important rule of all, knowing what you own. Okay, let's get into the framework itself. Categorizing a stock is the very first step in building its story. It tells you what kind of company you're dealing with, and maybe most importantly, what you can realistically expect from it. We're going to start with the first three categories, which all fall under this big grower umbrella. But as you're about to see, just because two companies are growing doesn't mean they're the same kind of investment. Not at all. First up, we've got the slow growers. Think of these as the huge, mature companies, like your local electric utility. They were probably fast growers once upon a time, but they've hit their peak. Now they just kind of chug along, growing a little bit faster than the overall economy. A key sign you found one? They often pay out a nice, steady dividend, because they just don't have enough exciting new places to reinvest all their profits. And this just illustrates the whole idea perfectly. Lynch's analogy is brilliant. Look at this chart for Houston Industries. You can see there are no big mountains or deep valleys. It's just a gentle, rolling, pretty flat landscape. You don't buy these stocks for explosive growth. You buy them for stability and that reliable dividend check. Next up are the stalwarts. Think of these as the reliable workhorses of your portfolio. These are your Procter & Gamble's, your Coca-Colas. They're still massive, massive companies, but they're growing at a more respectable 10 to 12% a year. A lot of people love these because they offer pretty reliable growth. And, this is important, they tend to hold up well during recessions. People are still going to buy soap and soda, right? And the chart tells the story perfectly. See, this isn't flat like Delaware, but like Lynch says, it is no Mount Everest either. You're just in the foothills. The key insight here is how you make money. You buy a stalwart for that reliable growth, and after you get a solid 30 to 50% gain, you sell it and you rotate that money into another stalwart that hasn't had its run yet. Okay, now for the really exciting one, the fast growers. These are the small, aggressive upstarts growing at a blistering 20 to 25% every year. This is where you find the stocks that can multiply your investment 10, 20, even 100 times over, the real home runs. They find a winning formula, and they just expand, city by city, mall by mall. But, and this is a big but, be warned, for every one fast grower that becomes a legend, dozens of others flame out and go bankrupt. And there it is. Just look at that. This chart of Walmart back in its prime, that's not Delaware, and it's not the foothills, it's a straight-up rocket launch. This is the kind of life-changing return that investors dream about. The challenge, of course, is finding them early enough and then knowing when that explosive growth phase is finally starting to slow down. Okay, so we've covered the growers. Now let's completely shift gears to a different type of company altogether, the cyclicals. With these stocks, the story isn't about constant growth. It's all about the boom and bust of the economic cycle. With these guys, timing is everything. So cyclicals are companies and industries like cars, airlines, steel, that kind of stuff. When the economy is strong, hey, people buy new cars, they take vacations, and these companies make billions of dollars. But when a recession hits, their profits can literally vanish overnight. Their performance is tied directly to the health of the broader economy. And this right here is Lynch's most critical warning. People mistake big, familiar, cyclical companies like Ford for safe stalwarts like Bristol-Myers. But they are completely different animals. As you can see from these charts, buying a cyclical at the wrong time, at the peak of the economic cycle, can absolutely crush your portfolio. We're talking wiping out 80% of your investment or even more. All right, our last two categories are for the detectives out there. These are the turnarounds and the asset plays. This is where fortunes can be made by seeing what everyone else has missed, either because a company is in a deep crisis or because its true value is just hiding in plain sight. With turnarounds, you're basically betting on a great comeback story, a company like Chrysler that pulls itself back from the absolute brink of disaster. The cool thing is, their success is usually completely independent of what the broader market is doing. And with asset plays, you're a treasure hunter. You're looking for a company where Wall Street has totally missed something valuable, like patents, real estate, or just a giant pile of cash that's worth more than the entire stock price. So we've got our 6 categories, but here is the final and most crucial piece of the puzzle. These labels, they aren't permanent. A company's story is always evolving, and a stock can move from one category to another over its lifetime. Disney is the perfect case study for this. It started out as a fast grower with just incredible momentum. Then it grew into a stalwart, a massive and financially powerful corporation. Later on, investors realized the incredible, overlooked value of its real estate and its film library, which made it an asset play. And in the 80s, when it hit a really bad slump, it was even a successful turnaround story. This just shows you how dynamic these categories really are. All right, let's just do a quick-fire recap of the 6 categories one last time. You've got the slow and steady slow growers, the reliable stalwarts, the explosive fast growers, the timing is everything cyclicals, the comeback kid turnarounds, and the hidden treasure asset plays. But remember this, putting a stock into one of these boxes isn't the end of your research, it's just the beginning. It tells you what kind of story you're dealing with. Is it a slow burn drama or a rocket launch, a comeback story or a treasure hunt? This framework doesn't give you the answers, but it gives you the right questions to ask. So now the real work begins. What story are your investments really telling you?
So, we're tackling a massive question today. What exactly makes a perfect stock? Well, the answer, according to the investing legend Peter Lynch, is probably the exact opposite of what you're thinking. Okay, let's dive into the 13 signs of a true winner that you might be completely ignoring right now.
I mean, think about it. When you picture that perfect stock, what comes to mind? Is it some cutting-edge gene splicing company? A business that's literally building the future? Look, that's what most of us think. But all that excitement, all that glamour, more often than not, it's a trap.
And this classic quote from Peter Lynch just flips the entire idea on its head. See, he wasn't looking for genius-level complexity. He was looking for a business so simple, so fundamentally sound that it could survive even if an idiot was running it. Because, as he pointed out, sooner or later, one probably will. This simple idea is the key to everything we're about to explore.
Just look at this contrast. Imagine you're at a party, you say you own Gene Splice International. Sounds pretty impressive, right? Very futuristic. But what if you say you own Pep Boys, Manny, Mo, and Jack? You'd probably get some funny looks. But here's the thing. Lynch points out that while everyone was chasing the flashy story, Pep Boys was the one quietly making its investors rich. Its ridiculous name was the perfect disguise for a truly fantastic business.
And that right there, that leads us to our first big idea, the beauty of boring. The simple truth is, a total lack of glamour is a huge competitive advantage. It's like a built-in defense system against all the hype chasers and, more importantly, against Wall Street analysts. It gives you, the investor, time to buy in before it ever gets trendy and expensive.
So check this out. These are the first 4 attributes Lynch looks for. See a pattern here? It sounds dull, or like we saw, even ridiculous. It does something dull. It does something disagreeable. Or it might even do something depressing. These are the kinds of things that make professional, buttoned-up investors just turn their noses up. And that is precisely where the opportunity is hiding.
All right, let's make this real. Take a classic example, Crown, Cork, and Seal. What do? They make cans and bottle caps. You literally cannot get more boring than that. But because it's so incredibly dull, nobody pays any attention to it. This gives a great company with fantastic earnings the time to just quietly compound its value year after year before anyone on Wall Street even notices it exists.
Okay, so that was dull, but what about disagreeable? Let's look at Safety Clean. They handle the greasy, dirty sludge from auto repair shops and restaurants. I mean, what Wall Street analyst wakes up in the morning excited to write a 50-page report on grease traps? Yeah, pretty much nobody. And that complete lack of attention is exactly what allowed the stock to go on an incredible run.
And this brings us to what might be the ultimate example. Service Corporation International, or SCI. Their business? Funerals. It's a topic Wall Street would much rather ignore. So for years, this company was completely shunned. Meanwhile, they were rolling up a fragmented industry, creating what Lynch brilliantly called a McBurial, and they produced absolutely incredible returns for the few investors who were willing to look at a business others found just too depressing.
So we've established that boring is basically beautiful in the investing world. But now, let's get into the why. Let's talk about the structural reasons, the actual blind spots that Wall Street has, which create a goldmine of opportunity for the individual investor.
First up, the spin-off. This is when a giant corporation decides to take one of its divisions and, kick it out of the nest to let it fly on its own as a brand new, independent company. And here's the crucial part. The parent company wants the spin-off to succeed, so they usually set it up for success with a really strong balance sheet and a clean slate.
And hey, don't just take my word for it. The proof is right here in the numbers. This chart shows a whole list of spin-offs. Just look at the high column compared to the first trade price. Companies like Primark International or Argonaut became absolute home runs. See, what happens is big institutions get these new shares and often just dump them immediately because the new company's too small for them. That selling, for no good reason, creates a massive buying opportunity for you.
But the granddaddy of all spin-off stories, it has to be the breakup of AT&T. This one event created 7 new Baby Bell companies. Millions of regular people were sent shares, and while the old parent company AT&T just languished, those 7 spin-offs, on average, more than doubled. They beat the market twice over. The information was there for everyone, just hidden in plain sight. Okay, so let's quickly recap these massive Wall Street blind spots. We've got spin-offs, which we just covered. Then there are companies with low institutional ownership. If the big shot mutual funds aren't paying attention, the stock is probably cheap. And finally, and this one is super counterintuitive, we've got no growth industries. Think plastics or cans. In a hot industry, everyone is fighting for a piece of the pie. But in a boring, no-growth industry, a great company can be the big fish in a quiet pond, just gaining market share for years without anyone even noticing. All right, so we've found these overlooked companies. Great. But what makes the business itself strong? What's the secret sauce that gives it a durable, almost unbeatable edge? Let's dig in. It all comes down to one word: a niche. Think of it like a castle's moat. It's something that protects the business from competition. It could be a powerful brand name, a legal patent, or maybe even a local monopoly. And Lynch has this absolutely perfect analogy to explain it. A jewelry store has competition from everywhere, the store across town, online, you name it. But a rock pit? It has a local monopoly. Rocks are so heavy and cheap that a competitor from 2 towns over can't afford the trucking costs to come after your business. That is a powerful, protected niche. All right, here are 2 more incredibly powerful edges to look for. First, does the company sell something that people have to buy over and over again? Think razor blades, soft drinks. It's a beautiful, recurring revenue stream, not some one-time fad. Second, you want to find companies that use technology, not the ones that make it. A computer company isn't a brutal price war, but a payroll company that uses those ever-cheaper computers, its costs just go down year after year. Okay, we're almost there. You found a boring company in a sleepy industry, and it has a killer niche. Awesome. Now, how do you know you're right? How do you confirm it? Well, this final section covers the 2 ultimate signs that a company truly believes in its own success.
The first clue is watching what the insiders are doing. Now get this, insiders, the CEO, the CFO, the people who know the business best, they sell stock for all kinds of reasons. They need to buy a house, pay for college, whatever. But there's only one reason they buy their own company's stock. They think the price is going up. On average, they sell more than twice what they buy. So when you see them buying heavily, you need to pay attention.
But you want to know the absolute #1 best sign of confidence? It's when the company itself bets on, well, itself. It's when it buys back its own stock. Instead of wasting money on some dumb acquisition, it's investing in the thing it knows best. This shrinks the number of shares out there, which automatically boosts earnings per share. It's the simplest and best way a company can reward its owners. And nothing shows the power of this like these 2 charts. This is it. On the left, you've got Chrysler. After its big turnaround, it started aggressively buying back stock, and the share price went through the roof. And then on the right, you have Navistar. They kept issuing millions of new shares, diluting their owners. As Lynch put it, the stock never recovered. It's a tale of 2 completely different stories. One created massive value, and the other destroyed it. All right, so we've gone through all 13 of Peter Lynch's signs for the perfect stock. Let's put this all together. What does this dream company actually look like in the wild? Lynch paints this perfect picture of a fictional company he calls Cajun Cleaners. It's got a ridiculous name and a boring business removing mildew. It's a recent spin-off that no analysts are covering. It has a great niche thanks to a new patent. And, most importantly, the insiders are loading up on stock. And the company itself is buying back shares like crazy. It literally checks every single box we've talked about. So, here's the big takeaway from all this. The perfect stock probably isn't the exciting, futuristic company that everyone's talking about. It's much more likely to be a boring, overlooked business with a strong, protected niche that is quietly and consistently buying back its own stock. We've walked through the 13 signs. The only question left is, what's your Cajun cleansers?
All right, welcome to The Explainer. We spend so much time talking about what makes a great investment, but what about the stuff you should absolutely run away from?
Well, today we're diving into the mind of a legend, Peter Lynch, to figure out which stocks he learned to avoid, often the hard way. Trust me, these are the traps that can seriously sink your portfolio, and his advice? It's as sharp today as it ever was. So let me ask you something. Have you ever heard a stock tip that just sounded electric? You know, the kind that makes you want to pull out your phone and buy it right now. It's that company that's going to change the world, everyone's buzzing about it, it just feels like a sure thing. Well, here's the kicker. Peter Lynch says that feeling, that exact excitement, might just be the biggest red flag you'll ever see. Okay, so here's how we're going to break this down. We're looking at 4 major danger zones that Lynch pointed out. First up, chasing hype instead of value. Then we'll get into this brilliant term he coined, diversification. After that, it's all about those stocks that are just stories with no substance. And we'll finish up with 2 last but super important red flags. All right, let's dive into our first section, chasing hype, not value. This is all about the danger of the hottest stock in the hottest industry. And honestly, this is probably the most seductive trap out there. We're talking about the it stock, right? The one that's on every magazine cover, leading the news. Everyone's talking about it. And because of that, it feels like a safe bet. But Lynch, he says that widespread excitement is your cue to hit the brakes and get really skeptical. And this quote from him says it all. If I could avoid a single stock, it would be the hottest stock in the hottest industry. I mean, think about that. It's his #1 rule, and it goes completely against our instincts. He figured out that when a stock gets super popular, the price totally disconnects from reality. It's not about the business anymore, it's about hype. And that social pressure to buy in, it's powerful, but it's a terrible reason to invest. And here's why. These stocks, they're not rising because of solid earnings or a healthy balance sheet. No, they rise on hope and thin air. Lynch's big insight was that they're basically floating on pure optimism. Think of it like a hot air balloon that doesn't have a basket. It looks amazing going up, but when that hot air, that optimism, starts to cool, there's absolutely nothing to stop it from crashing right back down to earth. Want a classic example? Look no further than the Home Shopping Network. I mean, check out this chart. The stock went on this insane ride from $3 to $47 in just over a year. But then it collapsed all the way back to $3.50. Why? Because the price was fueled by nothing but hype. The actual business, the earnings, they were nowhere near enough to justify that price. It's a brutal lesson, right? For every single person who got lucky and sold at the top, there was someone else buying, thinking the dream was still alive. And believe me, this wasn't just a one-off. Lynch saw this exact same pattern play out again and again. You look at this list: carpeting, mobile homes, digital watches. These were all at one point the next big thing. They were can't-miss industries. But what happened? A flood of competition came in, profits got squeezed to nothing, and investors got burned. The really interesting part is, even if the industry itself is growing, that fierce competition can make it an absolutely awful place to put your money. Okay, let's move on to our next section, the diversification trap. This one is all about when good companies start making bad decisions. And this danger zone is a little more subtle. It's not about some hot new startup. Nope. This is about a solid, successful company that suddenly starts doing really weird things with all its cash. And Peter Lynch, being the genius he was, came up with the perfect word for it: diversification. Get it? Worsification. It's what happens when a company is swimming in cash, and instead of doing the smart thing, like improving its main business or giving dividends, it just goes on a crazy shopping spree. They start buying up other companies that have nothing to do with what they're good at. It's all about getting bigger, not better, and it almost always ends up destroying value. And if you want to see this in action, you've got to hear the tale of 2 shoe companies, Melville and Genesco. They both decided to diversify. But here's the crazy part. One of them became a massive success story for investors, while the other one just completely imploded. So what was the secret sauce? What did one do right that the other got so wrong? Well, it all came down to the strategy. Melville was smart about it. They moved slowly, they bought businesses that actually made sense, where their retail know-how could help, like CVS pharmacies. It was synergistic. Genesco, on the other hand, they went on a wild, chaotic buying binge, snapping up 150 totally unrelated businesses. They got bigger, for sure, but the company became this tangled, incoherent mess. And the stock price? Yeah, it showed exactly what a disaster that was. Okay, Section 3, stories without substance, or what Lynch called the lure of the whisper stock. Now, this danger zone, this one might be the most tempting of them all. We're talking about companies with these incredible, futuristic stories, the kind that promise to change the world as we know it. Lynch gave these a great name, whisper stocks. You know the type. They've got the cure for cancer, or some revolutionary new energy source, or some super complex tech that sounds amazing. The story is always, always fantastic. But there's one tiny little thing missing. Actual earnings, profits, money.
And Lynch's quote here is just perfect. This is where the sizzle is so delectable that you forget to notice there's no steak. He's saying the story, the sizzle, is so good, so appealing, that we completely forget to look for the actual business, the steak. You get so caught up in the dream that you forget to check if there's any reality to back it up.
Oh man, and for a prime example, you have to look at KMS Industries. Their story was something else. It was like they were writing a sci-fi novel. One year, it's amorphous silicone photovoltaics. The next, it's chemically driven spherical implosions. I mean, what does that even mean? The story kept changing, kept getting more and more futuristic. And all the while, the stock price was just tanking. It went from $40 all the way down to $2.50.
So when you look at a company like KMS or any of these other long shots with amazing stories, what do they all have in common? What's the one thing that connects all of them?
It's pretty simple, really. The great story had no substance. There was never a real profitable business behind the curtain. No earnings. Just a really, really good story. And Lynch's advice on this is so smart. Just wait for proof. If a company is truly going to change the world, you don't have to be the first investor. You can wait until they actually prove they can make money and still make a killing. All right, we're on to our last section. 2 final red flags. Lynch left us with a couple of simple but really powerful things to watch out for. These are easy to spot if you just know what you're looking for, and they can save you a world of hurt. Okay, first up, beware the middleman. What this means is if a company gets a huge chunk of its sales, like, say, 25 to 50% from just one customer, you should be very, very careful. That single customer has all the leverage. They can squeeze prices, make crazy demands, or just walk away, which would be a total catastrophe. And the second red flag? Beware the exciting name. It sounds silly, but a company with a flashy name that has words like advanced, micro, or some mysterious X in it is often just trying to sound more impressive than it is. Meanwhile, a super boring name might be hiding an incredible business.
So let's just run through Peter Lynch's avoid list one more time, shall we? Number 1. The hottest stock in the hottest industry. Stay away. Number 2, companies that are getting into diversification. 3, those whisper stocks that have all sizzle and no steak. 4, suppliers that depend way too much on one customer. And finally, number 5, companies with flashy names that don't mean anything.
In the end, all of this fantastic advice from Lynch really comes down to one single question you have to ask yourself. Before you invest, are you buying a solid business or are you just buying a good story? It forces you to cut through all the noise, all the hype, and focus on what's real. Because what Lynch taught us is that being a great investor isn't always about finding the next big winner. A lot of the time, it's about being smart enough to avoid the next big loser.
Welcome to The Explainer. Today, we're going to tackle that one question every single investor asks. What really makes a stock price go up? I mean, really? Well, according to the legendary investor Peter Lynch, the answer has nothing to do with complex algorithms or Wall Street secrets. Nope. It all comes down to one fundamental truth about business.
So here's our game plan for this explainer. First, we'll dive into what actually makes a stock valuable. Then, we'll have a little fun with Lynch's human stock analogy. After that, we'll look at the unbreakable bond between price and earnings, decode the PE ratio, talk about the dangers of getting caught up in hype, and wrap it all up with how companies actually grow.
All right, let's kick things off with the most basic question of all, right? When you buy a share of stock, what are you actually buying? What is the thing that gives it its real fundamental value?
And here it is, the core idea you have to get. A share of stock isn't just a lottery ticket. It's not a blip on a screen. You are buying a small piece, a tiny slice of a real, living, breathing business. And that business, it has stuff, assets. And more importantly, it has earnings, which, let's be honest, is just a fancy way of saying profits after all the bills are paid. Lynch's whole argument is that, in the long run, a company's stock price is totally anchored to these things. But above all, it all boils down to one thing: earnings.
Now, to make this idea really, really stick, Peter Lynch came up with this brilliant analogy. It's a fantastic way to think about different types of companies. He basically asks us to imagine different people and their jobs as if they were stocks you could actually invest in.
It's a fun way to look at it. Okay, so first up, you've got your slow growers. In the stock world, they're like the stable utility companies. They're super reliable, they're secure, and they offer you predictable but pretty modest growth. A safe bet, for sure, but definitely not where you're going to find those mind-blowing returns.
Then you have the stalwarts. Think middle managers. These are the human versions of those big blue-chip companies like a Coca-Cola. Just strong, steady performers that are pretty much the backbone of the whole economy.
Next up, we have the cyclicals. Their income isn't steady at all. It's all feast or famine, coming in these big bursts. For companies, you can think of car manufacturers or airlines. Their profits totally depend on whether the overall economy is booming or busting.
Now, this category is a little different. Here, the value isn't really about what they earn. This is what investors call an asset play. The real gold isn't in the company's annual profits. It's in the stuff the company already owns, what's on its balance sheet.
And then you've got the turnarounds. These are the comeback stories. They've been totally beaten down. Maybe they lost a ton of market share or had a huge product flop, but, and this is a big but, if the core business is still solid, they have the potential to bounce back in a massive way.
And finally, the fast growers. We're talking actors, inventors, athletes. Now, let's be real. The failure rate here is insane. Most of them don't make it. But for that tiny few who do succeed, the struggling actor who finally lands that blockbuster role, or the tiny startup that invents the next big thing, their earnings can just explode. I'm talking 10, 20, even 100 times bigger, almost overnight.
Okay, so that analogy is a great way to categorize companies. But how does this whole idea that earnings are what drive value actually play out in the real world? Well, let's look at some visual proof. Let's look at what Lynch calls the unbreakable bond between a company's earnings and its stock price.
With all the crazy daily noise, the screaming headlines, the short-term ups and downs, it's easy to get lost. But Lynch insists that one simple relationship decides a stock's fate over the long haul. It's this. If the earnings go up, the stock will eventually follow. And if they go down, well, you guessed it, so does the stock.
And this chart just illustrates the point perfectly. Take a look at Dow Chemical. That jagged line, that's the stock price going all over the place day to day. And the smoother line, that's the company's earnings. Just look at how closely the price follows the earnings line. It's almost like they're dancing together, When earnings rise, the stock goes up. When earnings stumble, the stock follows right behind.
Now, this chart for Avon, this shows you what happens when that dance gets completely out of sync. For a while there, the stock price just soared, way, way above the actual earnings line. It was totally detached from reality. And then what happened? Well, when earnings finally stumbled, financial gravity, let me tell you, it took over with a vengeance. The stock just collapsed, crashing right back down to that earnings line it should have never left.
Okay, so it's one thing to see this relationship on a chart, right? But how do we actually measure it with a number? Well, that's where a simple but super powerful tool comes in, the P/E ratio.
The price-to-earnings ratio, or just PE for short, is basically your go-to metric. It's a quick way to get a read on whether a stock might be way overpriced or maybe, just maybe, a bargain, all relative to its actual power to make money.
And here's a really great way to think about what it actually means. If you buy a stock with a PE of, say, 10, it means that if the company's earnings just stay the same, it'll take them 10 years to earn back the money you just invested. A PE of 40? That's 40 years. See? That simple little thought experiment immediately puts the price you're paying into some serious perspective.
And listen, the math here could not be easier. Seriously, you just take the current price of one share and you divide it by the profit that one share made over the last year. So in this old example for Kmart, you take the $35 price, divide it by the $3.50 in earnings, and boom, you get a PE ratio of 10. Simple as that.
All right, so now that we know what the PE ratio is, let's look at the dark side. Let's see what happens when investors completely ignore it and just get swept away by hype. Because an extremely high PE ratio, well, it's like trying to run a race with a giant weight tied to your ankle.
This is one of the most insane examples Lynch ever saw. Ross Perot's company, EDS, it was a great business, no doubt about it, but investors got so excited they bid the stock all the way up to a PE of 500. I mean, 500! The crazy part is, the company actually did well. Its earnings grew consistently, but there was no way it could ever grow fast enough to justify that price. And eventually, the stock just collapsed under the impossible weight of those expectations.
And this quote about Avon just puts the sheer absurdity of it all into perspective. I mean, think about it. For a huge company like Avon to justify that high of a price, the expectations for its future growth weren't just optimistic, they were literally impossible. It's such a great reminder that no matter how amazing a company is, there's always a price that is just too darn high.
Okay, so if the PE ratio tells us all about the price you're paying for past earnings, then the real multi-million-dollar question is this: how is the company going to grow its earnings in the future?
Well, according to Lynch, it's not some kind of magic trick. Future earnings growth really comes from just 5 basic strategies. It's a playbook. First, they can reduce costs. Second, they can raise prices. Third, they can expand into new markets. Fourth, they can just sell more in their old markets. And finally, number 5, they can pull off a turnaround by fixing or getting rid of a part of the business that's losing money.
And that right there is the crucial takeaway. Your job as an investor isn't to be a psychic. You don't need a crystal ball. Your job is to be an investigator. You have to understand the company's story, figure out which of those 5 paths to growth they're on, and then just check in every once in a while to see if the plan is actually working. So the next time you look at a stock, don't just ask what's the price, ask a better question. What's the story?
All right, let's talk about investing. What if I told you the most important part of your research has absolutely nothing to do with numbers? Today, we're going to dive into this really powerful exercise from the legendary investor Peter Lynch. It's a simple test that goes way beyond the balance sheet and forces you to answer one absolutely critical question. Look, you've probably done the hard work, right? You've analyzed the PE ratio, you've checked the debt load, but can you actually explain why this company is going to succeed? Peter Lynch argues that if you can't, you are just not ready to invest. It is all about the story. So here's what we're going to cover. First, we'll break down what Lynch even means by the story. Then, we'll look at how you can craft one yourself. After that, we'll dig into 2 really fascinating case studies from Lynch himself. One was a massive winner, and the other, well, a painful loser. And finally, we'll reveal the one big question that separates success from failure. Let's jump in. To Peter Lynch, a stock isn't just some ticker symbol blinking on a screen. It's a piece of a real business. And every single business has a story, a narrative that explains what it's doing and how it plans to grow. You know, understanding that narrative, that's your real edge. And this is it. This is the 2-minute drill. The idea is so simple. Before you buy a single share, you have to be able to deliver a short monologue about why you're buying it. You need to be able to state it so clearly that, in Lynch's words, even a child could understand it. And this isn't just some homework assignment. It's your ultimate gut check to see if you actually know what you're buying. But here's the really important part. The story isn't one size fits all, not at all. The narrative for a fast-growing tech startup is going to sound completely different from the story of a struggling industrial giant. So Lynch breaks it down into categories. Let's look at a few of his own examples.
Okay, so for a fast grower, the story is all about one thing: expansion. Think about a company like La Quinta back in its early days. You're not just buying the hotels it has today, you're betting on the hundreds more it could build tomorrow. The whole story is about how much runway it has left to keep growing like crazy.
Now, for a cyclical stock, a company whose fortunes rise and fall with the economy, like a car company, the story is all about timing. Your little monologue isn't about endless growth. It's about seeing the tide turn. You're looking for signs that the industry slump is ending and that the company has gotten lean and mean to profit from the upswing that's almost sure to come.
And then you've got the turnaround. Here, the narrative is all about recovery. The company has made some big mistakes, often through what Lynch famously called diversification, which is when a company diversifies for the worse by buying businesses it just doesn't understand. Your story needs to pinpoint exactly how they're fixing those mistakes, like selling off those weird divisions and getting back to their core mission. Okay, theory is great, but let's see this in action. We'll start with La Quinta Motel Inns, a stock that turned into a massive home run for Lynch. And it all kicked off with one of his favorite research tricks, asking the competition what they think. I mean, this is pure gold. Lynch says there is nothing more bullish than begrudging admiration from a rival. So when a vice president at Holiday Inn, the dominant player at the time, actually admitted that this little upstart La Quinta was killing them, Lynch knew he had to drop everything and investigate. And what he found was brilliant. La Quinta's story was just so simple. Offer the exact same quality room as a Holiday Inn, but for 30% less. How? Easy. They just got rid of all the extras that added cost but didn't make money, like big conference rooms and fancy restaurants. They figured out most hotels actually lose money on their restaurants. So they just let a Denny's open next door and focused only on what mattered: a great room. So you see, their story was just rock solid. They had a really clear target, the business traveler. They kept costs incredibly low with a repeatable design. They got smart financing so they didn't have to take on risky bank debt. And this is the most important part. We'll come back to this. They had already proven the concept worked in several cities.
So what was the result of this well-researched, compelling story? Well, Lynch bought the stock and made an 11-fold return, an 11-bagger. That is the power of knowing the story inside and out. But what happens when you fall in love with a story that has a fatal flaw?
So let's pivot to the cautionary tale of a company called J. Bildner and Sons. This is a story about how your own personal experience and a product you just love can blind you to a massive investment mistake. This was Lynch's supposed edge. See, Bildner's was a specialty food store right across the street from his office, and he ate their sandwiches for lunch all the time. He knew the product was fantastic, and the story was simple. This beloved local shop was about to go national. And his hopes were huge. He saw a perfect niche, high-quality takeout food for busy professionals. He checked the financials, saw they were avoiding debt, and he got really excited. He was convinced he'd found the next Taco Bell, and he bought the stock at its IPO of $13 a share. The dream was big. But that dream quickly became a total nightmare. Instead of expanding cautiously, builders suffered what Lynch calls multiple and simultaneous failures. Their concept totally bombed in department stores. It failed in New York City, where it just couldn't compete with all the established delis. They burned through all their cash in this frantic, doomed expansion. And here's the painful result. The stock collapsed from $13 a share all the way down to just 1/8 of a dollar. Basically worthless. Lynch ended up selling his shares for huge losses. This final, painful remark from Lynch just says it all, doesn't it? A great product is not the same thing as a great stock. And you can bet that every time he ate one of their sandwiches after that, it was just a bitter reminder of the critical question he forgot to ask. So what was the fatal flaw? What was the difference that separated the 11-bagger from the stock that went to practically zero? It all comes down to one single billion-dollar question. This is it. This is the whole ballgame. This is the question he confirmed for La Quinta, but tragically overlooked for builders. He didn't wait to see if the good idea from his neighborhood would actually succeed somewhere else. You see, successful cloning is what turns a local gem into a national powerhouse. So this brings us to a simple takeaway drill. Just 3 steps. Step 1, go ahead and find that exciting local company with a great story. But then, step 2, you wait. Be patient. Let them prove the model can be copied. And then, step 3, you invest only after they have shown they can succeed elsewhere, when that successful cloning is a proven fact, not just some theory on a prospectus. Remember this because it's so important. Avoiding a big loss is just as valuable as picking a big winner. If Lynch had just waited to see if Bildner's expansion actually worked, he never would have bought the stock in the first place. A little patience would have saved him a fortune. And that is the question I really want to leave you with. Before you get swept up in the excitement of a product you love or a story that just sounds amazing, stop, pause, and ask yourself, have they proven this concept can be cloned? Are you really investing in a scalable, successful business model? Or are you just investing in a really, really great sandwich?
All right, let's dive right in. Today, we're cracking open the playbook of a true legend, the investor Peter Lynch. Now, forget all the confusing jargon and the super complex algorithms for a minute. We're going to build a really practical guide to stock research using simple but incredibly powerful techniques that literally anyone can master. So, let's get to it.
You know, this quote from Lynch just hits the nail on the head. It gets to the heart of a huge mistake that so many of us make. We get so caught up chasing whispers, right? Hearing rumors, hoping for that one secret tip, and we completely ignore the clear, factual information that companies are legally required to publish. The real story, as Lynch says, it's right there in the handwriting, and today we're going to show you exactly how to read it.
So where does the real advantage come from? Is it in that mysterious overheard advice, that hot tip you get at a restaurant, or some secret sauce? Or is it in the public information that's just sitting there, available to everyone? Lynch's entire argument, the core of his philosophy, is that the amateur investor's edge comes from that column on the right. All the crucial information you need is just waiting for you in annual reports and quarterlies.
So are you ready to stop listening to whispers and start reading the handwrite?
Okay, so to help you on this journey, we've basically broken down Lynch's process into a few key steps. First, we'll talk about how to get the most out of your broker, turning him into a real research partner. Then we'll go straight to the source, and I'll show you how to get valuable info directly from the company. After that, we'll explore what Lynch called the art of tire kicking. It's a surprisingly effective way to use your everyday life to spot amazing investments. And finally, we're going to demystify the annual report with a dead simple 2-minute drill that will give you a crystal clear picture of a company's financial health.
Let's start with your broker. Look, if you're using a full-service firm, you are paying for way more than just someone to place a trade. You're paying for their expertise, their resources, and their access to information. It's time to get your money's worth and actually turn them into your best research partner.
This slide just lays it out perfectly. It shows the massive difference between a passive and an active investor. Over on the left, you've got someone who's basically just taking orders. But on the right, that's an informed investor. That's someone who's driving the conversation, asking smart questions, and really taking control of their own financial future. This is how you change the entire dynamic with your broker and start making much smarter decisions.
So what should you actually ask? Here's a simple checklist to get you started. First off, ask them to classify the stock. Is it a fast grower, a slow and steady one, or maybe a cyclical company that moves with the economy? This just helps you understand the risks and rewards. Second, get the P/E ratio, and here's the key. Ask how it compares to the company's historical levels. This gives you a clue about whether the stock is cheap or expensive right now. Third, ask about the story. What's their debt situation? How are they planning to grow? Fourth, ask for the hard data. Analyst reports, charts, whatever they've got. And finally, find out who else owns it. A lot of institutional ownership can be a sign of confidence.
Okay, so once you've squeezed all the information you can from your broker, it's time to level up your research. It's time to go straight to the source, the company itself. And yeah, this means picking up the phone, sending an email, or even, believe it or not, paying them a visit.
You know, the pros call companies all the time, and there's absolutely no reason you can't too. When you call the investor relations department, just be prepared. Have your questions ready. Ask simple, open-ended stuff like, what are the positives and the negatives you see this year? You can also use the call to fact-check your own story. For instance, hey, I heard there's a backlog on Goodyear tires. Is that true? But please, avoid the rookie questions like, why is the stock going down? They don't know, and it just tells them you haven't done your homework. Remember, you're a potential owner of the company. They are there to answer your questions.
Now, beyond a phone call, Lynch was a huge believer in actually visiting a company's headquarters. And this quote just perfectly captures his whole philosophy. Rich earnings and a cheap headquarters is a great combination. In other words, he wanted to see companies that were laser-focused on making money for shareholders, not on building some fancy corporate palace.
And this just illustrates the point brilliantly. On the left, you've got the good signs, the bullish signs Lynch found at really successful companies. Taco Bell's headquarters? It was behind a bowling alley. Crown, Cork, and Seal had faded floors and a view of the factory. These are companies that have their priorities straight. On the right, you've got the red flags, the fancy furniture, the polished walls, a gorgeous headquarters on a hillside, like Uniroyal had right before it went downhill. As Lynch said, when the rubber trees move indoors, it's probably time to worry.
Okay, now for one of my absolute favorite techniques from Lynch. He called it the art of tire kicking. This is all about using your own personal real-world experience with a company's products and services as a powerful form of research. It's grassroots, it's on the ground, and as you're about to see, it can be incredibly effective.
Let's look at a few killer examples of this in action. Before Lynch ever invested in La Quinta Motor Inns, he didn't just read a report. No way. He actually went and stayed in their hotels for 3 nights. He wanted to see for himself what it was like to be a customer. Were the rooms clean? Was the staff any good? Was it a good value? This kind of first-hand experience gives you insights you will never, ever find on a spreadsheet.
Or take the case of Pep Boys. This is a great story. Lynch was visiting one of their stores when a salesman, with just unbelievable enthusiasm and knowledge, almost convinced him to buy a whole set of tires he didn't even need. Now for Lynch, this wasn't just a funny story. It was a huge light bulb moment about the company's culture and the quality of its people. He figured, hey, if they can sell this well to me, they can probably sell this well to anybody.
Remember when Apple's stock had totally collapsed and everyone was writing it off? Well, Lynch saw signs of a turnaround in the most ordinary places. First, his own family loved their Apple computer so much they wanted a second one for the house. That told him they still had a grip on the home market. Then, he noticed his own office had just bought 60 Macintoshes. That was a clear sign Apple was getting back into the business market. 2 simple observations, 1 powerful insight. Apple was coming back.
And it wasn't just about tech. When Chrysler was on the verge of bankruptcy, Lynch's confidence in their turnaround didn't just come from meeting the CEO. It came from something way more basic. He went to a showroom and saw the pizzazz in their new cars. He could feel the excitement. But he didn't stop there. He would literally walk through parking lots and just ask minivan owners, "Hey, how do you like your van?" And the overwhelmingly positive answers he got were all the confirmation he needed. He knew their strategy was working, not because a report told him, but because their customers did.
So what's the big takeaway from all of this? It's that your own everyday life is a powerful research laboratory. The supermarket where you might spot a hot new product, the restaurants you eat at, the stores you shop in, the cars you see in the parking lot, even your own house. These are all places where you can spot successful companies long before they ever hit Wall Street's radar. You just have to know how to look.
All right, for our final and maybe most important section, we're going to tackle the thing that seems to intimidate people the most, the annual report. But don't you worry. Lynch came up with a simple, powerful way to pull out the most vital information in just a couple of minutes. And we're going to walk through it step by step.
Here is the key to this whole process. This is the secret that will save you hours of time and frustration. When you get an annual report, ignore the glossy pages up front with the pretty pictures and all the corporate back padding. Flip right to the back, to the financial statements printed on that cheap, boring paper. That, as Lynch says, is where the real treasure is buried.
Okay, let's put this into practice with a real-world example. Ford's 1987 balance sheet. I know, it looks like a wall of numbers and your first instinct might be to just close your eyes. But stick with me. We are going to focus on just 2 simple rows to find out if this company's in great financial shape. I promise it's way simpler than you think.
Step 1. Look under current assets and find 2 lines, cash and cash items and marketable securities. Now, marketable securities are just things that can be turned into cash really fast. Add those 2 numbers together. For Ford, back in '87, that was about $10.1 billion. That's the company's total cash pile. Step 2. Now, just scan down to the liability section and find the line for long-term debt. This is the money the company owes that isn't due anytime soon. We focus on this because it gives us a really good picture of the company's long-term financial stability. For Ford, this number was $1.75 billion.
And now for the moment of truth. Step 3 is just simple subtraction. Take the total cash and subtract the long-term debt. In Ford's case, that leaves a positive $8.35 billion. This is what Lynch calls the net cash position. And let me tell you, having more cash than long-term debt is an incredibly powerful sign of financial strength. It means no matter what happens with the economy, this company is not going out of business.
But we can take this one step further to make it even more powerful. If you take that net cash of $8.35 billion and divide it by the number of shares out there, which was 511 million for Ford, you find out that there was a staggering $16.30 in pure cash backing up every single share of stock. This, right here, is your margin of safety. It's a financial cushion that protects you as an investor and gives you incredible peace of mind.
Wow, we've covered a lot of ground today, from turning your broker into a partner to mastering that 2-minute drill on a balance sheet. You now have a powerful playbook for doing your own stock research, for cutting through all the noise and getting straight to the facts. So the only question left is, which company in your world are you going to investigate first? The power is in your hands. Now go out there and use it.
Hey there, and welcome. You ever wish you had a simple, practical toolkit to just look at a company and get a real sense of what's going on? Well, today, that's exactly what we're going to build. We're diving into the timeless wisdom of the legendary investor Peter Lynch and looking at the famous numbers he used to find some of the biggest winning stocks of all time. So, here's our roadmap. We're going to start with the basics, how to gauge a stock's price. Then we'll look beyond that price tag to find hidden value. We'll add a tool for understanding debt, a really crucial one, and another for figuring out the deal with dividends. We'll also learn how to sidestep the classic book value trap. And finally, we'll zero in on what really truly counts for a company's success. Let's get into it. All right, first up, probably the most famous number in all of investing, the price-to-earnings ratio, or PE. It's the starting line for almost everyone. But as you're about to see, its real power, that only gets unlocked when you put it side by side with a company's growth. So what is it really? Simply put, the PE ratio is the price you pay for $1 of a company's profits. You know, if a stock costs $20 a share and it earns $2 a share, that's a PE of 10. It's just a quick and dirty shorthand for how expensive a stock might be. But here's the thing. A P/E ratio all by itself doesn't tell you much. Peter Lynch's genius was to compare it to the company's earnings growth rate. It's so simple but so powerful. If a company is growing its profits by 20% a year, but it's only trading at a P/E of 10, that could be a serious bargain. But flip that around. If it's growing at 10% with a P/E of 20, that's looking pretty unattractive and might just be headed for a fall.
And this is where you can really see the raw power of that growth. Just look at these numbers. You've got Company A growing at 20%, Company B at 10%. They both start out earning $1. After a few years, sure, there's a gap. But look at year 10. Company A is earning over $6 a share, while Company B is chugging along at just $2.59. That massive, ever-widening gap in earnings, that's the engine that drives incredible stock market returns over the long haul.
Okay, so now that we've got a handle on price, let's start looking beyond it. A stock's price is just the sticker price, right? The next tools we're adding to our kit help us pop the hood and look for hidden rebates and secret treasures right there on the company's balance sheet.
Lynch tells this fantastic story about Ford. The stock was trading for $38. Looked okay, but when he dug into their financials, he saw they were sitting on a mountain of cash, $16.30 for every single share. So when you subtract that cash, the real price he was paying for the actual car business was only $21.70. And just like that, an okay-looking stock suddenly looked like a total bargain.
And believe me, cash is just the beginning. Companies can have all sorts of amazing assets that are either totally invisible or just wildly undervalued on the books. I mean, think about a powerful brand name like Coca-Cola, or a patent for a blockbuster drug, or huge real estate holdings. These things are often carried at a fraction of their true worth, creating incredible hidden value for anyone willing to do a little digging.
Okay, now for a crucial safety check. Debt, it can be rocket fuel for returns, but it can also be an absolute company killer. Understanding not just how much debt a company has, but what kind of debt it has is one of the keys to avoiding total disaster.
And Lynch makes this critical distinction. Bank debt is the really dangerous stuff. Why? Because a bank can call you up and demand its money back at the first hint of trouble, which can easily push a company right over the edge. Now, funded debt, like long-term bonds, that's much safer. The company just has to keep making its interest payments, and that gives it precious time, breathing room, to work through a rough patch.
And this story from the 80s just illustrates it perfectly. You had two companies, GCA and Applied Materials. They were in the same high-tech business. And bam, the industry hit a downturn and both stocks got hammered. On the surface, they looked like two very similar, struggling companies.
But the outcome couldn't have been more different, and it all came down to debt. GCA was loaded up with that dangerous bank debt, and it went bankrupt. Gone. Applied Materials, on the other hand, had very little debt. It survived the downturn, and its stock went on to quadruple. The type of debt made all the difference between total failure and a massive fortune.
Everybody loves getting a check in the mail, right? Dividends feel so safe, so rewarding, but are they always the best use of a company's hard-earned cash? Understanding this debate is the next essential tool for our kit.
I mean, listen to John D. Rockefeller. There is this powerful, tangible pleasure in getting that dividend check. It makes your investment feel real. It's income you feel like you can count on, and that psychological pull is a huge deal for a lot of investors.
But here is the critical trade-off, and you really have to think about this. Every single dollar a company pays out to you as a dividend is a dollar it cannot put back into the business to grow. And for a young, fast-growing company, that reinvestment could be worth way, way more in the long run than a tiny check today.
This chart of the utility company Con Edison tells such a great story. After nearly going bankrupt in the 70s, it staged a comeback. But here's the thing. It didn't need to build a bunch of expensive new power plants anymore. So what did it do with all that cash that was just piling up? It started sending it back to shareholders as a steadily growing dividend. In this case, the dividend is a signal that the company has grown up and matured into a stable, reliable cash cow.
All right, next up, a metric you see everywhere, book value. The idea sounds simple enough, right? Just buy a company for less than its assets are worth on paper. It sounds like a surefire way to get a bargain, but honestly, it is one of the most dangerous traps you can fall into as an investor.
Take a look at this number, $60. $60 per share. Sounds pretty solid, doesn't it? A nice, tangible value you can hang your hat on.
Well, that was the official book value of the railroad giant Penn Central right before it declared one of the biggest bankruptcies in U.S. history. That $60 of value on paper offered its shareholders exactly zero protection because the assets it was supposed to represent were basically worthless
in the real world. This just highlights the whole point perfectly. Book value is an accounting number, not a real-world price tag. Warren Buffett learned this the hard way when he tried to sell off old textile machines. They were on the books for over $866,000, but when he took them to auction, he could only get $163,000 for them. The book value was a total fantasy.
So if earnings can be a little misleading and book value can be a total trap, what should we be focusing on? Well, let's add the final and maybe the most important tools to our kit, understanding the actual cash a business generates and its true profitability.
This concept right here is one of the most important things you can understand as an investor. Free cash flow. It's the cash left over after a company pays for everything it needs to run and grow its business. This is the real pot of gold. It's the money that's actually available to reward shareholders, whether that's through dividends, buying back stock, or making smart acquisitions. And check this out. This is a fascinating, kind of counterintuitive idea about profits. When the economy recovers, it's often the struggling, low profit margin companies that end up being the biggest winners. As this table shows, even a small improvement in business can cause their profits to just absolutely explode, more than tripling, while the already profitable competitor only sees a pretty modest gain.
So what have we really learned today? That the PE ratio, the debt level, the book value, they're all just clues. Each number is just one chapter in a much, much bigger story. Your job as an investor is to use this toolkit to look past the headlines and uncover the real story of a business. The only question left is, what story will you find?
So every investor has this dream, right? You find that one stock and it just takes off. But here's the thing, the hardest part isn't finding the winner. It's knowing when it's time to sell. The story that made a company great can change, sometimes really fast. And if you hold on too long, well, it can be a disaster. So how do you see the writing on the wall? Let's get into it.
This is the big question, isn't it? Is your winning stock still a winner? It sounds simple, but wow, the answer can be complicated. We're going to break down a framework that'll help you figure this out for every single stock in your portfolio. Because a company that was an absolute buy yesterday can turn into a sell today before you know it.
All right, here's our game plan. First, we'll talk about the discipline of rechecking the company's story. Then, we'll get into a really cool framework, the 3 phases of growth. We'll look at real companies that hit a wall, and one that just smashed right through it. Then, we've got a wild cautionary tale about Texas Air, and we'll finish up with what this all means for you, your edge as an investor.
Okay, first up, rechecking the company's story. This is so important. A company's story is not a set-it-and-forget-it kind of deal. Think of it like a living, breathing thing, and you gotta keep up with all the plot twists. And look, this doesn't have to be some huge, complicated research project. We're just talking about a simple, regular check-in. You know, skim the quarterly report, see if earnings are on track, or, and this is the fun part, do some real-world research. Go to the stores. Do they look busy? Is the stuff they're selling still exciting? These little check-ins are your early warning system.
So how do you actually structure this checkup? Well, there's a simple but really powerful way to think about it, by breaking a company's life into 3 different phases. And trust me, knowing which phase your company is in is absolutely crucial. Okay, so phase 1 is the startup. This is when the company's just getting going, working out all the kinks. It's super risky for an investor. Then you hit the sweet spot. Phase 2, rapid expansion. This is when they've found the magic formula, and they're just stamping it out in new places. This is often the safest and, the most profitable time to be invested. And then there's phase 3, the mature phase. The company's basically everywhere. Growth gets tough, and this is where the story gets really, really interesting and maybe a little dangerous.
Now, check this out. This table really lays it all out, the risk versus the reward. The startup phase, high risk but high reward. But look at phase 2, that rapid expansion. You get this incredible combo of lower risk but still high reward. That is the magic window. Once a company hits maturity, phase 3, things change. The risk goes up in different ways and the rewards tend to shrink. Your whole job is to figure out when a company is about to jump from phase 2 to phase 3.
And that brings us right to phase 3, when a fast-growing company suddenly slams on the brakes. The story that got everyone so excited starts to fall apart. And if you want to protect your profits, you have to know what to look for.
Let's take a company called Sensormatic. They had this amazing product. You know those anti-theft tags at the entrance of every store? For years, they were in that perfect phase 2, just expanding into thousands of stores. If you got in early, you saw the stock go from $2 to over 40. But then, what happens? They ran out of stores. The expansion story was just over. The music stopped, and that stock completely collapsed.
Or think about a giant like Sears. For decades, their story was all about opening new stores across the country. And they did it. They were in every important city. But once you've done that, the big question is, now what? The main engine of growth just ran out of gas. The story had to change.
And here's another perfect one, the Limited. They were a total mall phenomenon. But once they were in pretty much every single major mall in America, well, their name kind of said it all. They were limited. You know what the big red flag was? When they started buying up other clothing stores. That was a huge sign that their original high-growth story was finished.
But hitting that mature phase is not always a death sentence for a stock. Some of the truly great companies, they figure out how to write a whole new chapter. And there's no better example of this than McDonald's. Seriously, about a decade ago, everybody thought the McDonald's growth story was done. I mean, you couldn't throw a rock without hitting a McDonald's. But they were just getting started. Look what they did. They added drive-thrus. That's now a third of their business. They invented the breakfast menu, adding 20% to sales by using their kitchens when they used to be empty. They added new stuff like salads and chicken. And, this is the big one, they went all in on expanding overseas.
And this quote just nails it. Just because a company seems to be everywhere in one country doesn't mean the global story is over. Not even close. McDonald's proved that you can reinvent your growth story by looking at the rest of the world as a brand new frontier.
Now, for every McDonald's, there's a company that goes the other way. A story where investors get so mesmerized by the narrative, by the hype, that they completely ignore what's actually happening on the ground. This next one, this is a powerful lesson.
Just look at this absolute roller coaster. Mid-1983, Texas Air is at $12 a share. A few months later, it collapses after a bankruptcy scare. But then the comeback story begins. They slash cost, customers come back, and by '86 the stock has tripled. They start buying up other airlines, and Wall Street just falls in love with the story. The idea was to roll up failed airlines, cut costs, and make a fortune. By early '87, the stock hits over $51, a tenbagger, a 10 times return. The story was perfect. The reality was anything but.
And this is a confession from the legendary investor Peter Lynch, who actually owned this stock. He admits he got lazy. Why? Because the stock price just kept going up and up. He fell for the exciting story about the future, even while the fundamentals, the actual health of the business, were completely falling apart right in front of him. It's such a classic trap. When the price is rising, you start to believe the hype, no matter what reality is screaming at you.
And the warning signs here weren't buried in some obscure financial document. No way. They were right there, out in the open, in every single airport. Lost bags, constant delays. You had furious customers, you had angry employees, bitter union fights. This was not a secret. And to top it all off, the company had a mountain of debt from buying all those other airlines. The reality of the business was a total disaster.
And here is the predictable, brutal result. All the good stories in the world can't prop up a failing business forever. In less than a year, the stock collapsed, from over $51 all the way down to $9. A devastating crash that was totally predictable if you were paying attention to the facts, not the fiction.
But here's the really cool part. This story isn't just about avoiding a catastrophe. It's also about spotting a huge opportunity. Because the same exact information that told you Texas Air was in trouble was a massive green light for another company. This is where your edge as an investor really comes into play.
Just look at this contrast. On one side, you have Texas Air and Eastern. Angry customers, terrible service, shrinking business. So, what was happening to their main rival, Delta? They were cleaning up. Every single person who got fed up with Eastern was a potential new customer for Delta. As one company's story was failing, the other's was just getting better and better.
And this right here is what we call the amateur's edge. It's your superpower. Thousands of regular people who flew on those planes saw with their own eyes how awful Eastern service was and how much better Delta was. They had the information. They could see the story changing in real time, way before some analyst in a skyscraper did.
So that all brings us to one final, really important question. It's time to take this idea and apply it to your own investments. Look at the companies you own right now. Are they still in that sweet spot, that rapid expansion phase? Or are they starting to hit a wall? Are they reinventing themselves like a McDonald's? Or are they ignoring the warning signs like Texas Air did? What is the story your portfolio is really telling you today?
All right, let's jump right in.
If you've ever asked yourself, how do I actually analyze a stock? Then you're in exactly the right place. We're going to break it all down using the framework from a true legend, Peter Lynch, and his final checklist from his classic book, One Up on Wall Street.
And this quote, it really says it all, doesn't it? Lynch's whole philosophy is baked right into these words. He's telling us that investing isn't some crazy guessing game. It's not about chasing the latest hot tip. It's about really, truly understanding what you own. This is our North Star for this whole explainer, knowing the why behind every stock you buy.
Okay, so here's how we're going to tackle this. First, we'll get into the mindset behind the checklist itself. Then we'll cover the basics, the questions you have to ask about any stock. After that, we dive into the real core of his method, categorizing companies. And we'll finish up with some classic Lynch rules of thumb and how you can start building your own investing storyline.
All right, section 1. So, who was Peter Lynch? Well, he's famous for one huge idea, making investing something that everyone can do. His whole point, and it's a powerful one, is that you, the regular person, can actually have an edge over the Wall Street pros. You can spot amazing companies before they do. And the best part? You absolutely don't need a PhD in finance to pull it off.
And here's the good news right up front. This isn't about quitting your day job to stare at spreadsheets. Lynch was adamant that you can do solid, quality research on a stock in just a couple of hours. A couple of hours! It's not about boiling the ocean, it's about doing focused, smart work.
Okay, let's get into the nitty-gritty. These are the all-stock essentials. Think of these as the universal questions. It doesn't matter if the company is big, small, tech, or manufacturing, you have to start here.
First on the list is the P/E ratio. You've probably heard of it, price to earnings. Basically, it tells you how much the market is willing to pay for each dollar of a company's profit. But here's the thing Lynch stresses. A P/E number by itself is totally meaningless. The real magic happens when you ask, okay, is this P/E high or low compared to where this company usually trades? And how does it stack up against its biggest rivals? That's where the detective work really starts.
Okay, this next one is a little counterintuitive. Institutional ownership. You'd think, hey, if all the big hedge funds own this stock, that must be a good thing, right? Well, not so fast. Lynch actually looked for the opposite. He loved finding great companies that the big institutions hadn't noticed yet. Why? Because it meant he was getting in early, before the herd arrived and drove the price up. And here are a few other quick but crucial checks. Are the insiders, the CEOs, the CFOs, buying their own stock with their own money? That is a huge green flag. Is the company buying back its own shares? Also a great sign. It's like they're investing in themselves. You also want to see that earnings are growing steadily, not all over the place. A strong balance sheet, meaning not a ton of debt, is key. And this last one is so important. Net cash per share. It's like a built-in safety cushion. In a worst-case scenario, it gives you a sense of the hard, tangible value that's there. All right, now we get to what I think is the absolute heart of Peter Lynch's entire system. It's all about knowing your stock category. He believed, and I think he's right, that you can't even begin to properly analyze a company until you figure out what kind of story you're dealing with. You have to know what you own. Is it a slow, reliable company or a risky bet on a comeback?
So first up, the slow growers. Think of these like the big, old oak trees of the stock market. Maybe a big utility company. They're not going to grow to the sky overnight, but they're sturdy. The reason you own them is for one thing, that dividend check. So the questions are simple. Do they pay it like clockwork? Do they raise it over time? And, this is key, what's the payout ratio? If they're only paying out, say, 30% of their profits, that means they have a huge buffer to keep paying you, even in a tough year.
Category 2, the stalwarts. Think of names you know and trust, like a Coca-Cola or a Procter & Gamble. These are giants. They're not going anywhere, but they're also not going to double in a year. With these guys, the single most important thing is the price you pay. You can lose money on a great company if you overpay for it, and you have to watch out for what Lynch brilliantly called diversification. That's when a great company gets bored and buys some totally unrelated awful business that just becomes a boat anchor on its profits.
Then you've got the cyclicals, companies like car makers, airlines, steel producers. Their fortunes are tied directly to the ups and downs of the economy. When times are good, they're printing money. When a recession hits, they get hammered. For these, timing is critical. You got to watch things like inventory levels. Are cars just sitting on the lots, unsold? Bad sign. And this is where your personal knowledge, your edge, is huge. If you work in that industry, you know what's really happening on the ground long before some analyst in New York does.
Okay, look at this number, 20 to 25%. That's the magic number.
According to Peter Lynch, if you can find a company growing its earnings at this rate year after year, you might have just found the most exciting type of investment out there.
And that is the fast grower. This is where you find the 10 baggers, the stocks that can change your financial life. But of course, with big rewards comes big risks, so you have to be careful. Has the company proven its idea works in more than one city or state? Is there a giant market still left to conquer? Think about a small, successful regional chain that could go national. You're looking for that sweet spot, a proven winner with a long, long runway ahead of it.
Next up, the turnarounds. These are the comeback kids, the companies on the brink of disaster that might just pull through. We're talking high risk but potentially huge reward. And Lynch lays out a clear three-step process. Step 1, survival. Do they have enough cash to avoid bankruptcy? Step 2, the plan. What are they actually doing to fix things? Cutting costs, selling a disastrous division. And step 3, the proof. You have to wait and see if the plan is actually working. Is business really getting better?
And the last category is a special one, the asset play. This is like a corporate treasure hunt. It's when you find a company where the stuff it owns, maybe it's real estate or a pile of cash or valuable patents, is worth way more than the stock price suggests. The big question is, what are those hidden assets really worth? And is there anything or anyone that's going to force the company to unlock that hidden value for you, the shareholder?
Okay, so we've got our 6 categories down. Now let's blast through some of Lynch's best rules of thumb. Think of this as the condensed wisdom, the stuff you can stick on a Post-it note.
I love this slide because it just lays it all out, plain and simple. What to avoid and what to look for. He's saying run away from the hot stocks and the sexy industries that everyone's talking about. Instead, go find the simple, dull, maybe even ugly companies that no one cares about. Avoid the diversifications and companies drowning in debt. Look for a company that has a protected niche, a clean balance sheet, and is already profitable. It's that simple.
And a few more key principles to remember. Big companies have small moves, small companies can have huge moves. That's where the life-changing returns are. Use what you know from your job or your hobbies. That's your edge. And I really want to land on this one. Find a storyline for every stock you own. The story is your thesis, your reason for buying it in the first place. And your only job as an investor is to occasionally check in and ask, is my story still true? Oh, and of course, be patient. You can't force a great investment.
So, that brings us to the final and maybe most important idea, your investing storyline. See, this whole checklist, it's not a one-time exam. It's the beginning. It's how you write the first chapter of the story for your investment, a story that you'll follow for months or hopefully years.
And I just have to share this quote because it's so perfect. Think about it. When you buy a new fridge, you spend hours on it, right? You read reviews, you compare models, you measure the space. Lynch is just saying, hey, maybe you should put at least that much effort into a stock purchase, a decision that could be worth way, way more than a refrigerator.
So that's what we'll leave you with. When you use this framework, you stop being a gambler and you become an investigator. You're not just buying some letters on a screen. You're buying a piece of a real business with a real story. So the only question now is, what's the story of your next investment going to be?
Hey everyone, and welcome. Today, we're going to dive into the mind of a true investing legend, Peter Lynch. We're going to break down his incredible wisdom on one of the most important skills you can have as an investor, how to actually design a stock portfolio that's built to win. So let me ask you a question. Are you in the market dreaming of those huge returns? Are you hoping for 25, maybe even 30% every single year? It's a really tempting idea, right? But is that realistic? Is that a solid foundation to build your entire strategy on? Well, let's see what the master himself had to say about it. And there you have it, a classic dose of Peter Lynch reality. His point here is so important. Chasing these massive lottery ticket returns isn't just a little optimistic, it's actually dangerous. It sets you up for frustration, which then causes you to sell at the worst possible time or take these wild risks that just don't pay off. The key, as Lynch always said, is to focus on consistency, not on fantasy. Okay, so to build that consistent strategy, here's our game plan for today. We're going to walk through 5 key stages. First up, setting realistic expectations. Then, we'll get into diversification. After that, we'll break down Lynch's famous stock categories. Then, we'll cover his amazing gardening analogy from managing your portfolio. And finally, we'll get to what might be the most important part of all, mastering the right mentality. All right, let's start at the very beginning with the foundation, because before you even think about buying a single stock, you have to know what you're actually aiming for. Setting a realistic target is, without a doubt, the first step to long-term success.
This chart really puts it all into perspective. You could go with bonds, maybe get 4 to 6%, or you could just buy an S&P 500 index fund, do absolutely zero homework, and get around 9 to 10% over the long haul. So for all the effort you're going to put into picking your own stocks, Lynch gives us a super clear goal. A skilled amateur should be aiming for a 12 to 15% return. That's the sweet spot. It's ambitious, but it's also totally achievable.
So why is that 12 to 15% range so powerful? Well, it all comes down to the magic of compounding. Just look at this number. Over 10 years, $10,000 turns into over $40,000 at a 15% return. At the market average of 10%, it's almost $15,000 less. That difference, right there, is the reward for doing your homework and finding an edge. But hold on, you have to remember that your real return is what's left after all the costs. Lynch always reminded people to subtract everything. Commissions, newsletters, you name it. Think about it. If you're trading a lot, commissions can ding you for 1 or 2% on the buy and another 1 or 2% on the sell. You could be 4% in the hole before you even make a single dime in profit. That's a massive handicap that makes a long-term approach look a whole lot better. Okay, so you've set a realistic goal. Now for the next huge question, one that every investor faces. How many stocks should you actually own? This is one of the biggest debates in all of finance.
And you've really got two completely opposite schools of thought here. On one side, you have the all-in approach. Focus all your money on your absolute best ideas to maximize your returns. On the other side, you have that classic wisdom. Spread your risk out because you never know when something might go wrong. So, where does Peter Lynch land on this?
And of course, Lynch just cuts right through the noise with his famous pragmatism. For him, it's not about some magic number. It's about how many high-quality opportunities you can personally find and truly understand. The number of stocks you own should be exactly equal to the number of companies you've thoroughly researched and genuinely believe you have an edge with. Simple as that. Now, while there's no single magic number for everyone, he does give us a really practical guideline. For most individual investors, owning somewhere between 3 and 10 well-researched stocks is a really solid range. That gives you enough diversification to protect yourself if one company goes sideways, but it's still concentrated enough that your best ideas can actually make a real difference in your portfolio's performance. But, and this is a big but, he gives a huge warning against what he called foolish diversity. This is the trap of buying stocks you know absolutely nothing about, just for the sake of feeling diversified. It's a massive mistake. Owning one company you understand inside and out is way safer than owning 10 that you don't. Your real defense against risk isn't a long list of stocks, it's research. All right, so now we have a good idea of how many stocks to own. The next question is, what kind of stocks should they be? See, Lynch didn't view the market as just one big pile of stocks. He broke it down into distinct categories, and each one has its own unique personality. And here they are, his famous 6 categories. You've got your slow growers. These are the big, aging companies with low risk but also low potential. Then you have the stalwarts, like a Coca-Cola, which offer moderate, steady growth. Asset plays are companies with hidden gems on their balance sheet. Cyclicals are the ones that ride the waves of the economy. And then you have the really exciting ones, the fast growers, those small, aggressive companies that can become tenbaggers, and the turnarounds, struggling companies that could pull off a huge comeback. This chart gives us a fantastic look at how Lynch would actually put these categories to work. He wasn't just a growth guy or a value guy. He spread his bets across different kinds of stories. Maybe 30 to 40% in fast growers, sure, but then another 10 to 20% in stalwarts for stability, some in cyclicals, and maybe a few turnarounds. The whole point is to build a balanced portfolio that can do well no matter what the overall market is doing. But here is a critical warning that applies to every single one of those categories. Even the absolute best company on the planet can be a terrible investment if you overpay for it. Lynch often talked about Bristol-Myers back in the 70s. It was a fantastic company, but the stock was priced at 30 times its earnings, while the company was only growing at 15%. And the results? The stock went absolutely nowhere for years. The price you pay is every bit as important as the quality of the company you buy. So, you've built your portfolio. Now what? Well, this is where the real work begins. And to explain it, Lynch gives us his most famous and, honestly, most brilliant analogy. Think of your portfolio as a garden. This quote just perfectly nails the single biggest mistake so many investors make. They sell their winners to lock in these tiny little profits, but then they cling desperately to their losers, just hoping and praying they'll come back. Lynch says this is completely backward. You should be watering your flowers and pulling out the weeds.
Let's just walk through this flawed logic for a second. It's driven entirely by emotion, right? And it's all about the stock price. You sell a winner just because the price went up, completely ignoring the fact that the company's story might be getting even better. And then you hold on to a loser, ignoring the very real possibility that the business fundamentals are falling apart. It's a strategy based purely on price, not on value. Now let's contrast that with the Lynch method. It's a dynamic process he called rotation. If a stock you own runs up, but the company's story starts to get a little stale, you sell it. You take that money and you rotate it into an undervalued company where the story is getting better. And what if one of your stocks drops in price, but your research tells you the business is actually getting stronger? Well, that's not a reason to sell. That's a reason to buy more. It is always about the story, not the stock chart.
And that brings us to our final and maybe the most important section of all. Because you can do all the research in the world, but it won't help you one bit if you don't have the right psychological discipline. Success in the stock market is, at its core, a mental game. Lynch is absolutely crystal clear on this point. You have to erase this thought from your mind forever. If your default reaction is to sell whenever a stock was down 25%, you will never, ever achieve significant long-term gains. The correct mindset is the complete opposite. If I'm down 25% and my research on the company is still solid or even better, then I should probably be a buyer. A price drop in a great company is an opportunity, not a tragedy. And this is exactly why he hated automatic stop-loss orders. I mean, the promise sounds so sensible, right? I'll limit my loss to 10%. But the reality, as Lynch points out, is that in a volatile market, a temporary 10% dip is totally normal. The stop order triggers, it sells your shares, and it turns a temporary paper loss into a permanent, real one, often right before the stock rebounds. You've essentially guaranteed yourself a loss. And we'll end right here with the very core of the Peter Lynch philosophy. Do your homework, find a great company's story, buy it at a fair price, and then have the stomach, have the conviction to just stick with it. Don't let yourself get shaken out by all the short-term market noise. As long as that fundamental story is intact, or maybe even getting better, the simple act of holding on can lead to some truly amazing results. So the final question is this: are you going to focus on the price, or are you going to focus on the story? All right, let's get right into it. Today we are tackling what is maybe the most agonizing question in all of investing, and we're going to do it using insights from the absolute legend himself, Peter Lynch. I mean, seriously, when is it? When is that perfect, magical moment to pull the trigger? It's this puzzle that can just drive you nuts, right? Even the pros. You spend all this time trying to find the perfect moment to get in, and then you spend just as much energy worrying if you're getting out too early or way too late. But you know, Peter Lynch he cuts right through all that noise with this incredibly simple but powerful idea. He's basically saying, forget it. Stop trying to predict what the market's going to do tomorrow or next week. The real best time to buy, it's the day you've finished your homework. It's when you've convinced yourself that you've found a great company, what he calls solid merchandise, at a price that makes sense. See, it's all about the business itself, not trying to time the calendar. Okay, but here's the twist, and it's a really important one. Even though Lynch says you shouldn't try to time the market, he also says there are these, well, predictable times when the market might just hand you those great prices on a silver platter. He calls them the two big doors to opportunity. So door number one, it pretty much swings open every single year, right around the end of the year. It's this bizarre annual ritual, right? Where everyone, from big institutions to regular folks, they rush to sell their losing stocks just so they can claim a tax loss. I mean, think about it. It's the only time of year where losing money actually makes people kind of happy. And because of this big wave of selling, the prices of perfectly good companies can get pushed down for reasons that have literally nothing to do with how well the business is actually doing. Now, the second door, this one is a lot more dramatic. This is when the entire market doesn't just get the hiccups, it goes into a full-on freefall. You know those moments, total panic, fear is everywhere, and every instinct in your body is just screaming, sell, get out now. But Lynch says, hold on. These are the exact moments when incredible bargains show up. Because when people are scared, they sell everything. They just throw the good companies out with the bad without even thinking.
And look, this isn't just some nice theory. Here's the proof. Check out the market break back in 72 to 74. You could have picked up McDonald's for $4 a share. $4. And it eventually went to 61. Or Merck. It dropped to $7 and later shot up to 74. It's like these crashes are a time machine, right? They give you a second shot at buying these incredible companies you thought you missed out on.
And here we go again. This illustrates the point perfectly with the infamous 1987 crash. I mean, total chaos. In that panic, Coca-Cola got sliced almost in half, $53 down to 28. Home Depot, 28 all the way down to 12. But look at this. Look how fast they bounced back. Just a year later, they were pretty much right back where they started. The businesses themselves, they were fine. They never missed a beat. It was just the stock price that took a temporary nosedive.
Okay, so buying during a panic, that makes sense. But what about the other side of it? When do you sell? And honestly, this can be even harder. This is where even the absolute legends, including Peter Lynch himself, make some of their most painful, costly mistakes. Let's dive into a couple of his own stories, because they're pretty eye-opening. So picture this. Lynch takes over the Magellan Fund. He's doing his homework, and he finds Warner Communications, buys it at $26 a share. He loves the company. He loves the story. But then, some technical analyst whispers in his ear that the stock is extremely extended. And just those three little words, they got stuck in his head. And as the stock started to climb, his confidence just melted away and turned into pure anxiety. And what did he do? He sold. He let that one little seed of doubt from one offhand comment completely overrule all of his own hard work and research. He gets out at $38, patting himself on the back for being smart and prudent. And then he had to sit there and watch, just painfully watch, as the stock blew past $180. What a brutal lesson, right? He let outside noise completely dictate his decision. And believe it or not, it happened again with Toys R Us. Again, he did all the homework, he went to the stores himself, he got in early. And he made a 5-bagger on it. That's a 500% return. Sounds amazing, doesn't it? But he sold way too early. Why? Because he heard a rumor that some other big investor had stopped buying the stock. He thought a temporary pause was some huge fundamental problem. Well, that stock went on to be a 25-bagger. He left a fortune on the table.
So what is it? What's this powerful force that makes smart people make these kinds of mistakes? Well, Lynch has a name for it, and I guarantee every single one of us has felt this. He calls it the drumbeat effect. Think of the drumbeat effect as this constant, deafening noise of opinions and predictions and warnings coming at you from all sides. It's a message that gets repeated over and over and over again until it starts to feel like a fact, like it's the absolute truth. And that is exactly what got Lynch on Warner and Toys R Us. He tuned out the company's actual story, and he started listening to the market's loud, chaotic noise instead. And this drumbeat, it comes from everywhere. You know what I'm talking about. It's your broker calling you, hey, congrats on that double, don't be greedy now, let's lock it in, while they're really just thinking about getting 2 commissions. It's the talking head on TV saying with absolute certainty that tech is out, or industrials are in. It's the endless freaking out over some obscure economic number like the M1 money supply, which, as Lynch points out, most people couldn't even tell you what it is. It's all just noise, and it's designed to make you do something, usually something that's not in your best interest. Okay, so if we're supposed to tune out this drumbeat, then how in the world do we actually know when to sell? Well, the answer isn't some secret formula. It's not about predicting the future. It's about having a disciplined framework that is tied directly to the story of the company you invested in the first place. The whole strategy really just boils down to this one simple rule. Your reason for selling has to be directly connected to your original reason for buying. That's it. You have to remember the story. So, did you buy a beaten-down company hoping for a turnaround? Great. You sell when that turnaround is done. Did you buy a fast-growing company for its rapid expansion? Okay, then you sell when that growth starts to fizzle out. The sell signs are totally different depending on what kind of stock you own. So, for those big, stable, slow-growing companies, the stalwarts, you're basically on the lookout for signs of decay. Is the price, the PE ratio, getting way too high compared to its actual growth? Are they losing ground to competitors for a couple of years straight? Or, and this is a classic, are they making these boneheaded acquisitions in businesses they know nothing about?
That's what Lynch famously called diversification. And a huge tell are the executives, the insiders, not even buying their own company's stock anymore. Those are your clues that the story you bought into is starting to go sour.
Now, for cyclical stocks, think par companies, chemical companies, that sort of thing. It's all about watching the business cycle. The number one thing to watch for? Inventories. When you see their parking lots piling up with unsold cars, you know trouble's on the horizon. And for the turnarounds, the mission is crystal clear. You sell when the turnaround has actually happened. The debt is paid down, the business is back on its feet, the story you invested in is now over. Time to find the next one.
Okay, and then we have the fast growers. This is where the life-changing money can be made, so you have to be so careful to watch for signs that the rocket is running out of fuel. Are sales at their existing stores starting to slow down? That's a huge, huge red flag. Is the price just getting insane? A PE of 50 or higher means investors are expecting absolute perfection, which rarely happens. And here's one of my favorite Lynch indicators. When every single analyst on Wall Street is screaming buy and the company is on the cover of every business magazine, you might be getting dangerously close to the top. The hype just can't get any bigger. And really, that brings us back to the ultimate lesson learned from all those painful mistakes he made. When you've done your homework and you've found a really great company and the story is playing out exactly like you thought it would, or maybe even better, the absolute worst thing you can do is sell it just because of some noise, just because of that drumbeat. Look, a 5-bagger is amazing, but having the conviction to hold on for that 25-bagger, well, that's what changes your life.
So I'll leave you with this question, and it's one you really have to ask yourself all the time. What's actually driving your decisions to buy and sell? Is it that loud, frantic, chaotic drumbeat of the market? Or is it the quiet, steady, unfolding story of the business that you actually own a piece of?
So today, we're going to tackle some of the most common and honestly, most dangerous things people say about the stock market. And to do that, we're going to pull a page right out of the playbook of legendary investor Peter Lynch to dismantle the myths that can trap even the smartest people out there. Peter Lynch kicks things off with this absolutely brilliant observation. In most parts of our lives, we've moved on from superstition to science, but when it comes to our money, we somehow fall back on these myths that are just as illogical as blaming corn gods. And look, these aren't just harmless little quirks. These beliefs can be incredibly destructive to your portfolio. All right, here's our game plan. We'll start by looking at these modern superstitions in investing. Then we'll dive deep into the fallacies of price and timing. After that, we'll explore the psychological traps that trip all of us up, and finally, we'll land on what the real measure of a good investment actually is. First up, investing superstitions. And let's be really clear about this. Lynch points out that it's not just amateurs who believe these silly things. It's seasoned professionals too. So what does that tell you? Your intelligence is no defense against flawed market wisdom. Okay, so now let's get into the nitty-gritty and tackle the fallacies of price. These are so seductive because, on the surface, they seem to make perfect sense. They feel intuitive. But as we're about to see, that logic is fundamentally broken.
A classic. You've definitely heard this one, or hey, maybe you've even thought it yourself. A stock you're watching is in a total freefall, and you can't help but think, there's gotta be a floor somewhere, right? It feels like a safe bet. But that feeling, it's a dangerous illusion.
This slide just lays out the danger perfectly. I mean, just take a look at Polaroid. This was a respected blue-chip company. As it fell from over $143, you can bet investors at $100 a share were saying it can't go lower. They said it again at 90 and again at 80, but it did go lower, much, much lower, all the way down to about $14. The lesson here is so important. There is no safety net based on how far a stock has already dropped. The only real floor is zero. All right, so now let's look at the complete opposite, but, and this is key, an equally dangerous fallacy. This is that little voice of skepticism in your head, the fear that you've already missed the boat and that a stock that's been on a tear is just due for a fall. This is the exact kind of thinking that makes investors sell their biggest winners way, way too early.
Wow. Okay. This slide showing the performance of Philip Morris is just incredible. You can actually see Peter Lynch's own handwritten notes on the chart. Right here, back in the early 60s, after it had already quadrupled, he notes an investor might have said, "It can't go much higher." Oh, really? A decade later, after a 23-fold gain, they would definitely think it couldn't possibly go higher. But selling then, you would have missed another 7-bagger on top of that.
The lesson is crystal clear. If the business fundamentals are still getting better, there is no arbitrary ceiling on a stock's price.
Oh, this one. This is the siren song of the quote-unquote cheap stock. And the logic is so seductive. For the price of a fancy coffee, you can own a piece of a company. It feels low risk. It feels like a total bargain where you have very little to lose. But that feeling is a mathematical mirage. The math here is it's brutal and it's simple. Whether a stock costs $50 or $3, if that company goes bankrupt, your shares are worth zero. You lose 100%. The amount you can lose is always the same. Everything you put in. A low share price isn't an insurance policy. A lot of the time, it's actually a warning sign.
All right, next up, let's talk about the fallacies of timing. This is all about our deep-seated desire to be the hero, to buy at the absolute bottom and sell at the absolute top. It's a noble quest for sure. But as we're about to see, it's usually a foolish one.
And that leads us right to this popular, but oh so perilous investor pastime known as bottom fishing. It's the attempt to perfectly time your entry into a stock that's been beaten down to catch it just as it's about to turn around. It sounds so smart, but it's one of the most hazardous games you can play as an investor.
Lynch gives us this incredibly powerful, unforgettable analogy for this very thing. Trying to buy a stock in the middle of a steep decline is like trying to catch a falling knife. The odds are just so high that you'll grab it in the wrong place and get really hurt. A much better strategy is to wait for the knife to hit the floor, stick in the ground, and stop wiggling. In other words, wait for the price to stabilize and for the business to show real signs of a turnaround.
Okay, here's another timing trap, but this one's all about impatience. You've done your homework, you found a great company, but the stock price just isn't doing anything. Weeks turn into months, months turn into years, and you're getting bored, right? You start thinking, man, my money could be working so much harder somewhere else.
Lynch has this fantastic term for this phenomenon. He calls it the EKG of a rock. It's when the chart of a stock price is just a flat line for a really long time. But here's the secret. If the underlying business is still growing its earnings during this boring period, this is actually a really favorable omen. It means the stock is just getting cheaper and cheaper relative to its earnings, which sets the stage for a potential major move up later on.
And Merck is just the perfect example of this in action. Look at that top line on this chart. That's the stock price. From 1972 all the way to 1981, it was basically flat, the EKG of a rock. But now look at the bottom line. That's the company's earnings, which were growing steadily the entire time. Investors who got impatient and sold made a huge mistake. But those who were patient, they were rewarded with a fourfold return over the next 5 years.
Okay, so now we get to the really tough ones, the psychological traps. These are the biases and the emotional reactions that literally turn our own brains into our worst enemies.
You know that feeling. A stock you own drops, and it feels like a personal failure. Your brain is immediately screaming at you, you made a mistake, you were wrong. But the reality is that the market is just noisy. The stock's day-to-day price movement tells you absolutely nothing about the company's long-term prospects. Confusing the price with the business is one of the single biggest mistakes in investing. The company could be doing better than it ever has, even as the stock takes a temporary hit. And now for a really sneaky trap, good old-fashioned envy. You see that stock you almost bought just take off like a rocket? You look at the news and you start calculating all the money you could have made. This feeling, this fear of missing out, it doesn't just feel bad, it leads to incredibly destructive behavior. This slide breaks down what Lynch calls the FOMO pipeline, and it's a disaster waiting to happen. So step 1, you miss a huge winner, something like Home Depot. Step 2, you torture yourself over this fictional loss. Step 3, to make up for it, you chase the next Home Depot, like maybe one of its competitors. And step 4, well, the imitation underperforms, and that's when that fictional loss becomes a very painful, very real one.
So, okay, we've navigated all these crazy fallacies of price, timing, psychology. What's the solution? How do we find the real measure of success? Well, it all comes down to a fundamental shift in your focus. So here they are, Lynch's core principles, all boiled down. First, and this is huge, you've got to tune out the noise. Understand that price by itself tells you almost nothing. What truly matters is the story of the company. If the business fundamentals are strong and getting stronger, your patience will be rewarded. At the end of the day, you have to stop watching the stock ticker and start understanding the business behind it.
And really, that leaves us with this one final, absolutely essential question you have to ask yourself. When you look at your portfolio, what do you see? A bunch of blinking green and red tickers on a screen? Or do you see a share in the ownership of real, living, breathing businesses? Your answer to that single question will determine your entire journey as an investor.
All right, today we are diving deep into some of Wall Street's most seductive and, frankly, most dangerous tools. We're talking about options, futures, and short selling. Look, if you've ever felt that pull, that promise of getting rich quick, then you are definitely going to want to stick around for this. You know, this quote from the investing legend Peter Lynch really just sets the entire stage for us. It perfectly nails this massive shift in thinking that's happened. The old school idea of investing, right? It was all about long-term ownership. You buy a piece of a great company, you grow with it. But now, so much of the conversation has shifted to short-term speculation. It's all about placing bets on which way a stock is going to move and fast. It's a completely different game. And as we're about to see, it comes with a whole different universe of risks. So, here's what we're going to cover. First, we'll talk about the magnetic pull of what Peter Lynch calls side bets. Then we're going to get real and look at the brutal odds you're actually up against. After that, we'll walk through the absolutely tragic story of an investor who got the stock right and still lost every penny. From there, we'll break down why this is really a gambler's zero-sum game, we'll look at the dark art of betting against a company, and we'll wrap up with maybe the single most terrifying concept in all of finance: infinite loss.
Okay, first up, the allure of side bets. Right off the bat, Peter Lynch does not pull any punches. For him, options and futures aren't investments in the way we normally think about them. He calls them investment gimmicks and side bets, basically shiny objects that distract you from the real work of finding and owning great businesses.
I mean, just stop and think about the weight of that statement for a second. We are talking about one of the most successful fund managers in history. This is a guy who delivered unbelievable returns for more than a decade, sifted through thousands of companies, and yet he stayed away. He completely avoided these things. That alone should make you stop and think about where the real money is made and where it's most easily lost. And look, this isn't just Peter Lynch's gut feeling. He's got the cold, hard numbers to back it up. And honestly, they paint a pretty grim picture for anyone thinking about jumping into these markets. This right here, this is the number that should be burned into your brain. According to the reports Lynch cites, somewhere between 80 and 95% of amateur, non-professional players in the options and futures market lose money. Just let that sink in. This is not a 50-50 coin toss. This is a game where the vast, overwhelming majority of regular people get absolutely wiped out. Now, what's so fascinating here is the comparison to a casino. We all know the house has an edge in Vegas, right? But on games like blackjack, that edge might only be a couple of percentage points. But here, with options and futures for amateurs, it's not a small edge, it's a chasm. The odds of you losing are just astronomically worse than anything you'd find on a casino floor. And this is just pure classic Peter Lynch. It's such a brilliant, sarcastic takedown of the whole thing. He's just pointing out how absurd it is when you hear these complex, high-stakes bets being described as sensible investment alternatives. It's a witty, powerful way to just cut through all the jargon and show you the reality of the risk you're taking on. Okay, now we get to the real heart of it. This next part is a story, a cautionary tale that perfectly shows the deep, tragic flaw of trading options, even when you do all your homework and you get everything right. Let's call it the story of Sure Thing Inc. So I want you to picture this. Put yourself in the driver's seat. You've done the research, you've crunched the numbers, and you've found it, the perfect company. You are absolutely convinced this stock is about to take off. There's just one problem. You've only got $3,000 to invest. And this is the moment of temptation. With your $3,000, you could just buy 150 shares of the stock. Solid, straightforward. But then your broker mentions options. With that exact same $3,000, you could control thousands of shares. And if the stock makes the move you expect it to, you could turn that $3,000 into $45,000. That is the incredible, seductive power of leverage. A life-changing payoff. It sounds almost too good to be true, doesn't it? So, what do? You go for the options. You buy them in January and you're feeling great, but the stock just kind of sits there. It doesn't move. And you're just watching the calendar day by agonizing day. By the middle of March, that expiration date is getting awfully close and the value of your options has already been sliced in half. That ticking clock is your worst enemy. This is the brutal reality of options. Time itself is actively working against you, literally eating away at your money every single day. The pressure is just immense.
And then the day comes. The options expire, the stock never made its big move in your time frame,
and your $3,000 investment is now worth exactly zero. Gone. A total and complete loss. And here is the gut punch. A few weeks after your options expire worthless, the stock does exactly what you predicted. It skyrockets. You were right. Your analysis was spot on. But because you chose options, you weren't just betting on what would happen, you were betting on when it would happen. And you lost. This is the ultimate tragedy of options. You can be penalized not for being wrong about the company, but for being right on the wrong day of the calendar. So that story isn't just a sad anecdote. It actually points to a much bigger, almost philosophical difference between these financial tools and actually owning a piece of a business. This slide really breaks it down. When you buy a share of stock, your money is actually helping that company grow, hire people, build things, and create real value. It's what we call a positive sum game. If the company does well, all the shareholders can win together. But buying an option, it finances, well, nothing. It doesn't build a factory, it doesn't fund research. It's a zero-sum game. For every single dollar someone wins, someone else has to lose a dollar. It's just a giant transfer payment, as Lynch puts it, from the people who don't know what they're doing to the people who do. And on top of all that, options are just incredibly expensive to play with. You're constantly shelling out cash, paying these premiums just to buy more time. If you want to stay in the game on a single stock for a whole year, you might have to buy 4 or 5 different sets of options. And every single time you do that, your broker is taking a nice, healthy commission. It is no wonder at all that Lynch calls the whole thing the broker's gravy train. All those costs just create this massive headwind, making it even harder to ever come out ahead. Okay. So let's flip the script for a second and look at the other side of this speculative coin. Short selling. This is the practice of betting against a company, actively hoping that its stock price is going to go down. And just like options, it's another path that seems really tempting, but is just littered with its own unique and terrifying dangers. So how on earth does this actually work? Well, Lynch has a great analogy. Imagine you borrow your neighbor's lawnmower. You immediately go and sell it. Then you wait, hoping you can find the exact same lawnmower on sale somewhere cheaper. Buy it and return it to your neighbor before they even notice it was gone. That price difference, that's your profit. It's not illegal, but as Lynch points out, it's not exactly neighborly either. So here's how it goes down, step by step. Your broker does all the heavy lifting. You borrow shares, they get sold for you instantly, and the cash shows up in your account. Then you wait. If you're right and the stock price tanks, you buy those shares back for way less, they get returned to whoever you borrowed them from, and you keep the profit. It sounds pretty simple, right? But there is a terrifying catch. And that catch, well, it brings us to our last, and maybe most critical point of all, the danger of infinite loss. This is what makes shorting a stock fundamentally different and so much more dangerous than just buying one. Okay, you absolutely have to get this next part, because it's what makes shorting so uniquely dangerous. When you buy a stock, what's the worst that can happen? The company goes bankrupt, the stock goes to zero. You lose 100% of your investment. That's your maximum possible loss. It stinks, but it's a fixed number. But when you short a stock, there is no limit. There is no ceiling on how high that stock price can go. And because of that, your potential loss is, in theory, infinite. And believe me, this is not just a theory. This happens in the real world. Lynch tells the horror story of Robert Wilson, a very smart, very professional investor. He shorted a company called Resorts International, and here's the crazy part. He was eventually proven right. The company was a total mess. But in the short term, the stock went on an absolutely insane tear, from 70 cents all the way to $70. That's a 100-bagger, moving against him. Wilson was eventually forced to buy back the shares to stop the bleeding, losing an estimated $20 to $30 million. It's the ultimate proof that the market can stay irrational a lot longer than you can stay solvent. So we'll end with this question. After seeing the odds stacked against you, the tragedy of being right at the wrong time, and the very real risk of infinite loss, you have to ask yourself, when you use these tools, are you truly investing in a business? Or are you just placing a side bet in a giant global casino? It's a really crucial question to answer before you ever put a single dollar at risk. Thanks for watching. So what if I told you that the 50,000 smartest, most well-informed financial experts on the entire planet are consistently, predictably wrong? And what if their single biggest weakness could become your greatest strength as an investor? Today, we are diving deep into a legendary piece of wisdom from Peter Lynch, and we're going to explore his counterintuitive guide to profiting from Wall Street's biggest blind spot, its own self-inflicted panic. Okay, let's just kick things off with this quote because it perfectly captures the totally upside-down logic of the stock market. Peter Lynch, who is one of the greatest investors of all time, was constantly baffled by what actually spooked Wall Street. As he says right here, the literal world-ending threat of nuclear war was somehow less frightening to the market than a president just getting a little tough on a steel company. And look, this isn't just some funny anecdote. It is the absolute key to understanding the irrationality we're about to unpack. And that brings us to our first big idea, the market's reactions. So much of the time, justify all common sense. Lynch saw it over and over again. Wall Street's response to these huge, world-shaking events had almost nothing to do with the actual real-world impact of that news.
And this is where the absurdity really comes into sharp focus. The entire world holds its breath during the Cuban Missile Crisis. I mean, the closest we have ever come to total annihilation. And the market? It barely shrugs, dropping less than 3%. But just a few months before that, a verbal slap on the wrist for U.S. steel from President Kennedy sends the market into a 7% tailspin. This proves, right here, that in the short term, the market isn't driven by logic or some calm assessment of risk. No, it's driven by emotion and perception.
So, if it's not logic, what in the world is driving all this behavior? Well, Lynch points the finger directly at the massive rise of professional money managers, who, over time, came to completely dominate the market. He had this great name for them, the 50,000 Frenchmen, which is a little nod to that old saying, 50,000 Frenchmen can't be wrong. But on Wall Street, Lynch argued, they absolutely can be. You get this giant herd of professionals, all armed with the same data, all facing the same career pressures, and they all end up thinking alike. See, their goal isn't necessarily to find the best long-term companies. It's to outperform each other this quarter. And that creates this massive, unstable herd that chases the same hot stocks and then stampedes for the exit at the very first hint of trouble.
And this number just perfectly illustrates their frantic energy. In a single year during Lynch's career, a staggering 87% of all shares on the New York Stock Exchange changed hands. Just think about that for a second. To put that in perspective, just a couple decades earlier, that number was a mere 12%. The stock market had fundamentally transformed from a place where people owned a piece of a real business to, well, a high-stakes casino where chips were being traded at this dizzying, frantic pace.
So the really crucial point here is that the roles have completely flipped. It used to be that the professionals were seen as the calm, stabilizing force, right? While the individual investors were the flighty speculators. Now, Lynch argues, it's the professionals who are the short-term churners, while the everyday investor actually has the opportunity to be the patient, long-term force of reason. So what is fueling all this professional panic? It's what Lynch famously called climbing the wall of worry. This constant, frenetic churning is driven by this never-ending cycle of fear and anxiety that has really become a permanent feature of the market landscape.
You know the drill, right? The financial news cycle is basically a perpetual motion machine of panic. One month, the experts are screaming that the weak dollar is going to ruin us. The next month, oh no, now the strong dollar is the real threat. The specific fear is always changing, but that underlying emotion, worry, is constant. And this relentless drumbeat of doom is designed to do one thing: push investors into making rash, emotional decisions.
And all this constant worrying, it often leads to one of the biggest, most persistent fears for any investor. Are we on the verge of another Great Depression? It's the ultimate boogeyman, right? The thing that gets trotted out after every single major market decline. But as Lynch always pointed out, if you just take a quick look at the actual facts, you realize why this fear is largely unfounded. The economy today is a completely different animal than it was back in the 1930s. We've shifted from a fragile economy that was dependent on farming and manufacturing to a much more resilient, diversified, service-based economy. And most importantly, we have social safety nets like Social Security and unemployment insurance that act as massive shock absorbers. The foundation is simply far more stable now, making a repeat of 1929 highly, highly unlikely.
And all of it, leads to the single most powerful idea from Peter Lynch: the chaos, the panic, the frantic short-term thinking of that professional herd. It is not a threat you need to run away from. It is your single greatest advantage as an individual investor.
And the strategy for actually exploiting this is beautifully simple. You don't have to fight the herd or try to outsmart them at their own short-term game. You just have to use their predictable emotional reactions to your benefit. When they panic and they stampede out of a stock, they are essentially putting great companies on sale. Your job is to just be the calm shopper who walks in and starts filling your cart with incredible bargains.
And hey, this isn't just a theory. Lynch gave us concrete examples. In mid-1987, the companies you see on this list were all beloved by the big institutions. But after the Black Monday crash, the professionals dumped them in a panic, desperate to reduce risk and just avoid looking bad at the end of the year. The crucial point is that the businesses themselves were still excellent. In fact, in many cases, their earnings were even improving. The company hadn't changed, only the herd's sentiment had. And this created a once-in-a-decade buying opportunity for anyone who was focused on the business, not on the noise.
Okay, so how do we actually put all of this into practice? How do we train ourselves to think differently than the herd? Well, Lynch left behind a set of powerful, timeless rules that serve as a perfect guide. Let's walk through some of the absolute most crucial ones.
This is it. This is the single most important mindset shift you can make. I mean, think about it. In any other part of our lives, when the price of something we want goes down, we get excited, right? We rush to the store for a sale. You have to learn to view the stock market the exact same way. A market correction isn't a crisis. It's a 30% off sale on the world's best companies.
Just stop. Don't waste your precious energy trying to guess what the market is going to do next week, or next month, or next year. Nobody can do it consistently. Focus on what you can know, the fundamental story of the company you actually own. I love this analogy. Think of a company's earnings as a person walking a steady path up a hill. The stock price is their super energetic dog on a leash, right? It's running ahead, it's falling behind, it's zigzagging all over the place. In the short run, the dog's path seems totally random, but over the long term, it will always follow the direction of its owner. A company's profits, they're that owner. They're the ultimate anchor to reality.
This is a brilliant reminder to separate your emotions from your analysis. The stock doesn't know you own it, and it certainly doesn't care what you paid for it. The only question that ever matters is this: based on the facts today, would I buy this company? If the answer is no, you shouldn't be holding it, regardless of whether you're up or down on your initial investment.
Oh man, this is one of the most common investor mistakes. We do this all the time, selling our winners way too early just to lock in a small gain, and then holding onto our losers just hoping they'll come back to even. Let your winning businesses run, and be absolutely ruthless about cutting the ones whose stories have soured.
And this brings us to the final and maybe the most difficult rule of all. You have to accept that the wall of worry is a permanent fixture. There will always be a plausible-sounding reason to sell everything you own. Your job isn't to wait for the worries to disappear, because they never will. Your job is to accept that they exist and learn to tune out the noise.
Ultimately, Lynch's message is that successful investing isn't really about complex formulas or perfectly timing the market. It all comes down to two things: a fundamental optimism about the future and having the courage to think for yourself when everyone else in the herd is panicking.
And that really is the heart of it, isn't it? Instead of just listening to the headlines and joining the panic, the most profitable question an investor can ever ask is the one right here on your screen. Because the herd is always worrying about something, which means they are always overlooking a great company somewhere. Your job is to go find it.